want to deal with item number 9. Dealing with item number 9, scrutiny for the public record. Before we, earlier on we dealt with Schedule B items for COM 2018-357, 444, 486, 509, 535, 539, 599 and 605. And the decision of the committee was that these do not warrant further scrutiny. Full details will be published on the committee's website. Moving to item number 10, which is the sale of property loans project Glas by permanent TSB and other related matters. I want to welcome Mr. Masing and his colleagues to the meeting. Before we begin, I wish to advise the witnesses that by virtue of section 17(2)(I of the Defamation Act 2009, witnesses are protected by absolute privilege in respect of their evidence to this committee. If you are directed by the committee to cease giving evidence in relation to a particular matter and you continue to do so, you are entitled thereafter only to a qualified privilege in respect of your evidence. You are directed that only evidence connected with the subject matter of these proceedings is to be given, and you are asked to respect the parliamentary practice to the effect that, where possible, you should not criticise nor make charges against any person or entity by name or in such a way as to make him, her or it identifiable. Members are reminded of an outstanding parliamentary practice to the effect that members should not comment on, criticise nor make charges against a person outside of the House or an official either by name or in such a way as to make them identifiable. Can I invite Mr. Masing now to make your opening statement, please?
Thank you, Chairman. Chairman, deputies and senators, thank you for the invitation to meet with the committee this afternoon. I am joined by my colleagues, Eamon Crowley, Group CFO, and Shane O'Sullivan, Group Director of Operations. In these opening remarks, I want to set out my views on Project Glas in 4 sections. First, why have we done this transaction? Permanent TSB is a regulated entity. We are required to follow the rules and directions of our regulator. On the subject of NPLs, the direction is very clear in that we must reduce the ratio of non-performing loans on our balance sheet from 25% and in a relatively short time frame. This transaction is a critical part of our strategy to do so. Even without any regulatory requirement, reducing the NPL ratio is the correct strategy to pursue. Non-performing loans make the bank less secure, less able to compete, less able to grow or prosper, and less able to lend to new customers. No bank can continue indefinitely with an elevated NPL ratio. To do so runs undue risk for the bank, its customers and the taxpayer. Conscious of this, Permanent TSB has reduced the value of NPLs on its balance sheet by almost €4 billion, or 42% since 2013. And loans linked to over 13,800 homes have been restored to performing status thanks to the hard work of both the relevant customers and the bank. However, the bank's NPL ratio remains elevated. 10 years on from the start of the financial crisis, and as many commentators say, closer to the start of the next one than the end of the last one, the Single Supervisory Mechanism, or the SSM, requires urgent action from banks across Europe to reduce NPL levels, including Permanent TSB and other Irish banks. In this context, the European Commission, the SSM, and the Central Bank of Ireland have all said that loan sales are a legitimate tool for banks to use to reduce NPL ratios, a tool used by ourselves, by other Irish banks, and indeed by the National Asset Management Agency. And it's worth noting that key external observers have welcomed this transaction. Earlier this month, Moody's upgraded a range of key ratings and assessments for the bank, highlighting the Project Glas loan sale and noting, I quote, "The bank's improved asset risk profile following a decrease in its stock of problem loans." So secondly, what were the alternatives? Accepting the answer to the first question rules out continuing as is as a viable option. The main alternatives to a loan sale are debt forgiveness, individual deal arrangements, provide and derecognise, and scale repossessions. So let's look at these options in turn. On debt forgiveness, it's important to distinguish between this and debt write-off. The terms are often incorrectly used interchangeably. For example, Permanent TSB agreed to write off debt owed by over 2,000 buy-to-let customers on condition that they surrendered their investment properties for sale. The key here is that the customer agreed to forfeit the property that had secured the mortgage. Proponents of debt forgiveness want the bank to forget a part or perhaps all of a customer's debt without the customer having to surrender the underlying security in return. As the Governor of the Central Bank of Ireland told this committee last week, to have a functioning secured lending market in Ireland, security must mean something when borrowers default. Debt forgiveness creates an intolerable situation where the bank would effectively have to choose between similar customers as to who it should favour and who it should penalise. Think for a moment of two people with similar mortgages with the same bank living side by side. One neighbour, customer A, continues to make their repayments despite great challenges and hardship. The other, customer B, despite their best efforts, cannot meet their repayments and as a consequence builds up arrears. Debt forgiveness suggests that we should reduce the mortgage owed by customer B to a more affordable amount but maintain the mortgage of customer A as is. Effectively a relative punishment for keeping repayments up to date. Of course, fully accepting that customer B deserves help and protection to find a sustainable solution, no bank should want to have the power or responsibility to decide who to reward and who to punish in these situations. The same problem arises in respect of individual deal arrangements. All customers will not be treated equally. It creates a real moral hazard. In relation to provide and derecognise, we did not pursue this as there remains question marks about whether we could actually recognise the MPL set against increased provisions and indeed the cost to the taxpayer. As for scale repossessions, the system has spent 10 years avoiding this approach, so to my mind, it doesn't warrant further consideration. So this leaves loan sale as the least worst alternative. So thirdly, what does this transaction mean for customers? Here I seek to clarify the situation of customers whose loans are included in the transaction. I believe that these customers have been poorly served by inflammatory and inaccurate commentary around this transaction. The customers involved deserve to be treated with respect and care, not just by Permanent TSB, but by commentators, consumer advocates and other influencers whose opinions command attention. The Governor of the Central Bank of Ireland has been very, very clear. He has stated explicitly, including to this committee, that the protections which a mortgage customer enjoys with one institution remain when the loan is sold to a different institution. Nothing changes but the owner of the loan. Unfortunately, this reassuring message is ignored by many commentators, ultimately to the detriment of customers. And the Governor's views are supported by evidence. Project Glas is just one of numerous loan sales which have already taken place in the country in recent years. Yet where is the so-called tsunami of repossessions which is forecast with such certainty by the same commentators? Where are the thousands of customers finding that their terms have been altered once their loans have been sold? Where are the examples of the courts allowing new owners to renege on pre-existing contractual commitments? So lastly, the transaction. Project Glas was launched to the market in February. Binding legal contracts were signed on the 31st of July and the transaction will close before the end of the year. For the sake of an informed debate today, I believe it's worth clarifying exactly what loans were included and excluded from Project Glas and why. The bank originally identified circa 4.8 billion of MPLs for potential inclusion in the sale. A rigorous set of principles was developed to ensure a fair and consistent process was followed. This included applying a specific set of exclusion criteria. As a result, circa 2.6 billion of loans, some 48%, were excluded from the sale. This comprised the following categories of loans as they stood at the cut-off date for the transaction, which was the 31st of March. Number 1, PDH split mortgages which were performing to their restructured terms where they were not connected to other non-performing loans. PDH loans that were identified as meeting the terms of their agreed repayment arrangement, or ARA, which were on a path to performing status within 12 months, and again, were not connected to other NPL accounts. Loans that had cured from NPL status pre-cut-off, and operational exclusions, including PIA or bankruptcy, voluntary surrenders, those customers within the tracker mortgage examination loans, and mortgage to rent loans. So again, 2.6 billion of loans, or 48%, were excluded from the original perimeter of this transaction. And again, I should emphasise these exclusions included PDH loans that were identified at the time of cut-off as being on a path to performing status. Accordingly, the final Glas perimeter had a notional balance of circa 2.1 billion, comprising the following categories of loans, again by reference to their status at 31 March. All buy-to-let or buy-to-let linked non-performing loans. PDH loans, where the customer had failed to operate in line with an agreed treatment or where they had refused forbearance offers. PDH loans deemed non-cooperating. PDH loans deemed unsustainable following assessment of a customer's circumstance. In other words, no formal restructure offer could be made. And PDH loans in long-term arrears. In addition, there are two important points I want to make clear in regard to these inclusions. First, while the status of the loan at the cut-off date is key, we do continue to work with individual customers after that cut-off date because that's the right thing to do. However, any treatments or restructures which are agreed now will transfer with the accounts when the transaction completes. Secondly, there has been quite a bit of attention on the fact to what people have called performing split mortgages and their inclusion. If any such loans have been included in Project Glas, it is because of their links to other loans which are themselves non-performing, rather than their status as split mortgages meeting the terms of an agreed restructure. Please remember, we removed thousands of standalone PDH split mortgages from the transactions, approximately 900 million in value, where they were meeting the terms of an agreed restructure. By the same measure, therefore, if a customer had a fully performing loan and a non-performing loan, then both would transfer in this transaction. In both deciding and applying the criteria mentioned above, the bank has to balance the SSM definition of what constitutes an NPL against individual customer circumstances, whilst maintaining the governing objective of a meaningful reduction in the NPL ratio. The bank is satisfied that it met the required tests. To be clear, permanent TSB does not decide unilaterally whether a loan is performing or non-performing. The bank operates in a rules-based regulatory environment, and we apply the rules. And those rules are strict. At present, we assess whether an account is performing or non-performing at the end of each month. By the start of January 2021, we will be required to make that assessment each day. As to what constitutes a non-performing loan, I absolutely appreciate this is a complex area, and I appreciate that it can be confusing for customers and others. And it's further complicated by the fact that some people describe loans as performing if they are meeting the terms of a restructure agreement, which of course means they're not performing by reference to the original loan contract, and that's the critical reference point for the regulator. So ultimately, the bank's NPL strategy is about identifying individual loans which are in default of the original terms of the mortgage contract, linked to other loans which are themselves non-performing via either cross-default or cross-collateralisation, or deemed unlikely to pay, and they're loans for which there's no clear evidence that the borrowers are capable of honouring those terms by the end of the contract. We are bound by the SSM definition of what constitutes an NPL and by the comprehensive guidelines they set down as to what factors we and other banks must take into account for assessing whether an account is non-performing or performing. To date, when we have reviewed the various cases that have been highlighted in the media, for example, on this issue, we have seen no evidence that any of the relevant loans are incorrectly classified as non-performing at the relevant cut-off date by reference to the rules and guidelines of the regulator, the SSM. We will continue to monitor this up to the completion of the transaction. Finally, I should advise the committee that whilst we, as always, will endeavour to be as helpful as possible in responding to questions today, this is a commercial agreement and we're bound by a confidentiality clause in relation to discussing this transaction, which probably will restrict our ability to deal with all questions. Similarly, we're not in a position to answer specific questions relating to specific customers. This is the third time we've met with the committee this year to discuss this particular transaction, and we and I have always sought to be as helpful as possible, whilst mindful that this was a dynamic, evolving transaction with lots of moving parts. I assure the committee that I and we will try to be as helpful as we can this afternoon in the same manner. That brings me to the end of my opening remarks, and we're happy to take any questions.
Thank you very much. Deputy Doherty.
Maybe to start with the comments you had, you talked about inflammatory comments from individuals, and you talked about the care and respect that needed to be shown to customers. Can I maybe put one case to you, Mr. Masding? This is a case of a loyal customer who banked with your bank for 20 years, right through this recession, continued to meet their mortgage payments, went without, in certain instances, fuel, food, all the rest, to satisfy the payments to your bank. But this year fell on harder times and had to go into a restructuring with your bank, met the restructuring for a period of 6 months, and was in the process of sending in their standard financial statement to you, when at that time she informed you that she believed that she had identified cancerous cells in her body. 3 days later, you told her that her mortgage was being sold to a vulture fund, despite the fact that there was only €1,800 of arrears on this mortgage. Your letter to this woman, who at this stage was now battling cancer, who now had a second battle on her hand, which was to keep the roof over her head, was that she had to pay the full amount of her outstanding mortgage within 2 months if she wanted to prevent her loan being sold to Start Mortgages. Now, Mr. Masding, can I put it to you, in the context of that statement from one of your loyal customers, how can you stand there or sit there with a straight face and say that your bank is offering respect and care to customers when you are clearly turning your back on them and selling them off to the vultures?
There's a number of... sorry, good afternoon, Deputy. There are a number of responses I would make to that. First of all, post the crisis, in a secured lending market, you would expect many thousands of pieces of collateral to be realised by the bank because it's secured lending, not PTSB, all banks. And Ireland, for very good reasons, decided to avoid scale repossessions. At that time, PTSB engaged in a programme of long-term forbearance which kept many, many people in their homes using the various tools and techniques that we've designed. Secondly, as I mentioned in my opening remarks, we're a regulated entity, and I am bound by the rules and regulations which enables the bank to keep its banking licence and continue to compete. I don't set the rules for what an MPL is. And then thirdly, we again need to emphasise that we spent many hours trying to get the right mix of assets for Project Glas, and therefore that is why we have such a high level of exclusions. I can't comment on the individual case, but I would conclude by saying my job is, it was, and it always will be, to try and do the right thing for all Irish taxpayers. And that's about trying to get all the various dimensions in balance. So Project Glas is part of that.
But do you think that the response of your bank and you as CEO of that bank is a respectful one and a caring one to that individual who for 19 years, through very, very hard times, continued to meet every single payment, fell in hard times over the last year, went into a restructuring arrangement with you and met that restructuring arrangement for the 6 months, was engaged in terms of the second restructuring when you told them that you were selling off their mortgage and that they had to pay in full within 2 months if they wanted to prevent that, despite only having €1,800 of arrears. How can you say, in all sincerity, and you can, dress this up in NPLs and all the rest, AIB are not doing what you're doing. They're not selling family homes. Bank of Ireland are not doing what you're doing. They have the exact same regulator. We have the exact same ECB. We have the exact same definition of NPLs. But what you've done here, what you're doing to thousands of families, which are causing concerns, and you can blame others. You can blame others for inflammatory statements. Let me tell you this. The most inflammatory statement that these individuals got was the letter from you informing them that you had turned your back on them and that you were selling them off to mortgages. So can you tell me, or would you withdraw your comment to say that your bank is dealing with this in a caring and respectful manner? Because it's not. You're only looking after yourselves as an institution. If you were customer-focused, you would have read the letter from this woman. You would understand the trauma that she's gone through at the minute in her personal life. You would have looked at there's €1,800 for arrears. You would have acknowledged that for 19 years, for 10 of them, deep austerity, that this family met everything that the bank put in front of them. And you would not be turning your back on her and her family and selling her mortgage. And she's just one. We can pull out case files over and over again, Mr. Masding, to show that what your bank is doing is wrong. And no other bank is doing what you're doing. Like, you were forced by this committee and others to actually deal with the issue of split mortgages. And you come in here then as if, we've done a great job, we've stripped out this. Your original intention was to put split mortgages in. So maybe can I ask you, how many of the 7,400 owner-occupiers, people in family homes, are currently meeting their restructuring arrangements or the original terms of their agreement with the bank?
I will give you the first answer, and then I'll ask Shane to help me. I think two things I would say. First of all, in my opening remarks, I described Project Glas as the least worst alternative. The least compassion that the bank could show would be to repossess the properties. And we have, collectively as an industry, including PTSB, done everything we can to avoid that. That would be the first thing I would say. The second thing I would say would be that the buyers of the loans have been very clear that they will continue to honour the long-term treatments as provided by permanent TSB. So, Shane, is there anything else you'd like to add?
Yeah, well, I think this is a bank that has offered and a very significant amount of long-term treatments over the last 5 or 6 years. In fact, 30,000 long-term treatments. So we have a deep level of experience of what customers have gone through in that period. And for my own sake, I can say that I've met a large number of those customers, and I do understand the difficulty of their circumstances. The second thing I would say is I'd refer you back to Jeremy's opening remarks. So when the bank looked at its NPL ratio of 25%, which is much higher than the other banks that you refer to, we did work to take out a very large number of cases. And I think Jeremy referred to a figure of 48% or 2.6 billion. Now within that was vulnerable customers that were known to us, and those loans were removed from the sales process. You then move forward and the sale happens as it did at the end of July. And from that point, we don't have a general discretion to remove cases because they are actually for the new owner to decide upon. And I would say, as you've heard before, that the terms and conditions don't change, the regulatory environment doesn't change, the legal system doesn't change, and the new owner has the same responsibility to vulnerable customers as we do. So that's how that has developed in that particular case, I would imagine. You asked a second question then about performing loans. So our NPL ratio at the moment is 25%. This transaction brings that down to 16%.
My question is specific. My question is, of the 7,400 family homes that you are selling to the Vulture Fund, how many of them are meeting the original terms of their agreement or a restructured agreement agreed by the bank?
Let me think about that, if I can, for a moment, and I'll see if we can provide that figure under the confidentiality agreement that Jeremy mentioned in his opening remarks.
I think it's important that we try and agree the lexicon, though. There are no performing loans in Project Glas. Let's be really clear about that. There's no performing loans in Project Glas. They're either restructured, and therefore by definition they're non-performing, or they're part of a connection, and it's the connection that's non-performing loans.
But Jeremy, arrears recapitalisation is deemed as a restructuring loan. But if you're going to dress that up as a non-performing loan, which is in the same category as somebody who may have €100,000 of arrears and not paid anything in the last 7 years, it's not fair. And the reality is, there are hundreds, if not thousands, of loans that you are selling off. You haven't provided the figure yet. That are selling off, that are meeting their agreements and arrangements with permanent TSB. Isn't that the reality?
I think I've made the bank's position clear.
Do you not have the figures?
I have
You're in here to answer about Project Glas, and I want to ask a very simple question on behalf of the families out there. How many of those family homes are you selling that they are currently meeting the arrangements with the bank that was agreed between the customer and the bank, either the original arrangements or the restructured arrangements?
As I said at the start, we've entered into a commercial agreement, and I'm precluded from disclosing the details. The point of principle, Deputy, as I will keep repeating, is that loans that are in Project Glas are non-performing.
You'll tell us that their average loan is this, that the arrears are that, but you actually won't tell us because it doesn't suit your purpose to actually tell the public that what Permanent TSB is doing, a state-owned bank, that the Minister has completely turned a blind eye to and allowed this scandal to take place on his watch, is selling performing loans where people are meeting the restructured arrangement with your bank and you're handing them over to the vultures. Isn't that not the case?
I've entered into a commercial agreement with a purchaser that precludes me from disclosing details of the agreement or the granular detail. The loans that are in Project Glas are non-performing loans by dint of the various criteria which
Mr. Masting, have you not previously confirmed that 1,050 loans on family homes were deemed as performing or meeting the terms of its restructuring arrangements, and they are included in Project Glas?
When I was here, there were unidentified cases of 1,050, which I think is what you refer to. So if we go back, we disclosed to the market that Project Glas includes approximately 10,700 properties, 3,300 buy-to-lets, 7,400 PDHs. The disclosure stated that 7,400 PDHs consisted primarily of 2,500 non-cooperating and 3,850 cases where the treatments had been refused. So the remainder of the PDHs, the 1,000 that you referred to, Deputy, breaks down into three categories. Number one, they were originally buy-to-let, but the connection has changed to primarily PDH, and it's an NPL. Second, PDHs that are classified as not sustainable, i.e. there's a treatment that's just not possible. And thirdly, PDHs that are just in long-term arrears, that are identified as unlikely to pay. So I've already provided that clarification in response to media queries, so I'm happy to do it in front of this committee. Again, the bottom line, I think, is twofold for me. I'm trying all I can to get the best decision for all Irish taxpayers. The perimeter includes those which are defined as non-performing loans, as per the regulatory guidance.
Mr. Masing, you talked about this kind of debt forgiveness and punishment and forgiveness kind of idea. Can I ask you, in relation to commercial loans, how much debt forgiveness have you given over the last 5 years? How much debt has been written off without issuing or retrieving the assets that it may have been secured under?
There would have been zero debt forgiveness in permanent TSB, because that's not a strategy.
In terms of non-secured commercial lending, is it? Can you help me, Shane?
I can. Yes.
Please.
So,
thank you.
So we distinguish between debt forgiveness and debt write-off. So debt write-off is where the security or the property
is forgone.
Has been returned. So you'll be aware in recent times of our buy-to-let campaign, where we offered debt write-off to 2,000 customers. So of the 50-odd% customers that took that offer, in total we'll be writing off 125 million shortfall that would have been owed but will be written off now in return for those buy-to-let customers providing us with their property.
Yeah, but the question is in relation to commercial lending, how much lending over the last number of years have you written off?
Yeah, well, we don't do commercial lending. The most commercial lending we do
is on assets.
Is buy-to-let.
Okay.
Yeah.
Can I ask you in relation to the?
Sorry, and indeed, any commercial lending that we did have, that was part of the deleveraging that we've talked about before, that we were obliged to do by the European Commission.
Okay, but like the reality is, okay, I'm sure others will pick up in relation to this. You know, can I ask you in relation to the restructuring? Like you put it out in terms of what you should have done. Let me tell you what you should have done. You should have done what the other banks are doing, right? And I'm nobody to be shouting about the other banks. They can be doing a lot more. But what your bank is doing is simply pathetic. It is absolutely taking the easy option. It is selling up. It is turning your back on customers. And what you should have been doing is working through all of these arrangements with your customers in a more meaningful way than you've done. And I've given you examples, and we could give you loads of examples. Can I ask you, in relation to the number of solutions that are itemised under the Code of Conduct from A to K, how many of them does the bank not do?
I don't have A to K in front of me. If you do, would you be able to read them out to me?
Interest-only repayments?
Yes.
Permanent reducing of interest rate on the mortgage?
No.
Temporary reducing of interest rate on the mortgage for a specified period of time?
No.
The arrangement to pay interest and part of the nominal capital for a specified period of time?
Yes.
Deferring payment of all or part of the scheduled mortgage repayment for a specified period of time?
Yes.
Extending the term of the mortgage?
Yes.
Changing the type of the mortgage?
No.
Adding arrears and interest to the principal amount due?
Yes.
Equity participation?
No.
Warehousing part of the mortgage, including through a split mortgage?
Yes.
Reducing the principal sum to a specified amount?
No.
Okay. So the point I'm making is these are actually identified by the central bank as ways which you can work through these loan books. You gave a presentation earlier on, and what are we to do? We've tried everything. You actually didn't. There's 5 options there that you simply won't entertain for customers. That could be part of your solution, your basket of solutions, but you've simply not decided to do it.
They're a generic set of alternatives. The role of any bank CEO is to make sure that they apply the best alternative for all the taxpayers. We would have gone through all of those, and we will apply those which meet that test.
So I'm not aware of any lender who would offer all of those solutions. I'd also say they're not all mutually exclusive. There are variants on a theme in some of those. And again, I would also say we're probably the bank that has offered more long-term solutions to borrowers up and down the country than any other bank. We have 30,000 long-term treatments in place. And I'd also say that in terms of split mortgages, we're a bank that has offered over 40% of all split mortgages
I
ever
have
offered.
one final question on this, and I'm looking for the detail in this. Mr. Masding talks in kind of bravo terms about, oh, show me the court cases that are going to change these legal documents and all of the rest. That's not the issue. We all know what the issue here is. The issue is that a large number of the customers that you're now turning your back on have arrangements with Permanent TSB. Those arrangements will, over a period of time, will be up for review, and these vultures don't do the other options that you do. That's the problem. So they may have an arrangement now, which the vulture will be obliged legally to honour, but when it's up for review, you're on your own. And that's the problem. That's where you're really turning your back on these customers. So can I ask you, Mr. O'Sullivan or Mr. Masding, can you tell us of the 7,400 owner-occupier homes that are being sold, how many have arrangements at this point in time? And can you give us the number in each year that will be up for review? Those arrangements will be up for review.
So three responses, I think. First of all, I don't accept in any way, shape or form your description of my opening remarks as bravado. I purposely kept my voice as level as I possibly can. I don't make a point about bravado. I merely put some facts out there to create some debate. So I don't accept that comment. Secondly, in terms of the investment funds, or the vulture funds as you call them, I can't comment on the vulture funds, and it is unreasonable to ask me to. I assume in your own protocols you have engagements with those who buy loans, and I'll leave it at that. And then thirdly, unless my team correct me, I don't think we have an agreement with the purchaser to give that level of detail. Is that correct? Correct. That's correct.
To the minute, I would ask the chair maybe to try and pursue that. They're Permanent TSB's loans at this point in time. The state own them. The state own your bank. We're the Finance Oireachtas Committee, and I think an appropriate question that should be answered by a state-owned bank is how many of the family homes are in restructuring, and at what period are those restructures up for review? Because that is the dynamite out there, because that's where we know when the vultures will prey.
The contract was signed on the 31st of July. At that time, both parties entered into the contract as per market conventions. There's a non-disclosure agreement in that contract. I'm afraid I can't answer your question.
McGrath.
Thank you very much, Chair. I'd like to thank Mr. Masding and his colleagues for coming in before us. I think it should be said publicly that Start Mortgages were invited in as well and have declined the invitation. Lone Star have refused on a number of occasions to come before this committee. So when you talk about the concerns that people have when their loan is sold, and that some of those concerns you might suggest are unfounded, the fact that we can't get engagement from those buying these loans will raise those concerns even further. And it is very legitimate for us as a committee to seek to engage with those who are buying these loans and ask them the type of questions about long-term restructures, what they do when they purchase these mortgages, the nature of the arrangements they enter into, and so on. And we can't get any of that information. So that's not a matter for you, but it needs to be said publicly, and it is deeply regrettable and disappointing that we can't get that level of engagement. If they have nothing to hide, then they would have nothing to fear from coming in and taking questions about how they're going to handle loans that are so intrinsic to people's day-to-day lives. And I just want to make that point, Chair. If I can just move on, Mr. Masding, when is this transaction going to be executed? So you signed contracts on the last day of July. And you wrote to customers on the 2nd of August, and you said the transaction would not be executed, or the transfer date would not be in less than 2 months. The 2 months has now expired. When will this transaction go through?
Anyone, could you?
In quarter four, we're in quarter four now, but it's in the public domain that we've said November. So I'd expect towards the latter end of November.
The latter end of November?
Yes.
And what will be the next communication with customers, and who will it be from?
There will be two communications with customers, one from us in effect advising the customer that the relationship with the PTSB is ended, and there will be also communication from Start Mortgages to opening up the relationship with the customer.
Okay, so the next communication will be after the transfer date. People will be written to by permanent TSB telling them their loan has now transferred.
As soon as it's practical, within days of that date, yes.
And whatever the transfer date is, the day-to-day relationship with the customer, does that transfer immediately?
That transfers as well, yes, that's right.
So the customers will get a further letter then from the purchaser giving them the contact details and so on for the day-to-day management of their loan?
Yes, exactly, yes. Yeah.
Just to cut to the chase, really, at this stage, is there any flexibility whatsoever in relation to removing certain loans from this transaction? So loans that have since cured and are no longer non-performing since you signed a contract at the end of July. So from the end of July to the end of November is possibly 4 months. And as I understand it, loans that have been in an arrangement for 12 months where that arrangement has been honoured, they can migrate from non-performing to performing subject to certain conditions. So it's almost certainly the case that some loans that were classified as non-performing in July come November will now be deemed to be performing loans. So is there any flexibility to remove cured loans or loans that are well on the way to being reclassified as being performing?
There isn't. I think it's the best way to answer your question. Let me give you some context on that, please. So, as I mentioned before to Deputy Doherty, we concluded a significant exercise to try and get to the best perimeter we possibly could, and that resulted in us finding 48% of the original perimeter and put into exclusions. We've now entered into a commercial agreement with the purchaser, and as I've mentioned, that precludes us from disclosing details of the agreement. What I can say and confirm is that all loans at the time of signing were NPLs. So post-signing, subject to final reconciliation, there'll be no further exclusions. I would also say that this also means there'll be no further inclusions. So by definition, banking is an evolving beast, and there'll be customers who go into NPL status between the 31st of July and the day of final cash consideration, and there'll be no further inclusions either. So that's essentially market convention, that's market practice, and certainly from a PTSB perspective in terms of the deleveraging we've done in the past and any future capital markets relationships that we might have, it's important that we meet the standards that the capital markets expect.
Okay, but in very simple terms, the transaction is locked in.
That's correct.
And what if you find errors? If you do find between now and the end of November loans were incorrectly reclassified, we have had lots of individual interactions with bank customers who are raising all sorts of issues. And if you do find errors, can they be rectified?
Those errors would be reconciled. I'm sorry, I was answering your question at a macro level. The deal was done on the 31st of July. Yeah. There's a commercial arrangement. We have to follow the conventions of the capital markets. We have done. The deal will close when the cash consideration happens. There'll be a reconciliation at the end, and I think I'm correct in saying.
Right.
Sorry, Amy, please.
So, Deputy, we're receiving information from customers since the announcement of the sale, and we're looking at all of that information and all the communication. Indeed, we're communicating back with customers as well. And if an error has been found with regard to a misclassification, which isn't a non-performing classification, because the portfolio, as was mentioned by Jeremy, the cut-off date was the 31st of March, so that is the perimeter we work from. If there was an error with regard to a classification of a customer for any particular reason, we will deal with that accordingly. And indeed, that's part of the communication process with the customer. But that's more of a technical reconciliation up until the 31st July.
Yeah.
Other than that, it's a normal part of just the final shutdown of any, closure of any transaction.
There's a kind of a mixed message there.
Just summarising. Okay.
Yeah,
so the message I want to get out there, Deputy, is the bank does not have a general discretion to remove loans from the transaction.
Yeah.
It does not have a general discretion to include new NPLs in the transaction. So that's the first 2 points. And then the third point is there will be a technical reconciliation before cash is exchanged. And if there are errors found, they will be netted out of the transaction. I think that's the best way for me to summarise it.
Specifically with regard to errors, the word is error.
Yeah.
Yeah, but if you find out that a loan currently lined up for sale was actually not correctly classified at the end of March, can you remove it?
All loans at the end of March are NPLs in the perimeter.
But what if you discover that one or more actually weren't?
That is not the case. It's not the case that there's a performing loan in the, except if it's, sorry, we have to be, because it's outlined in the communication, except if it's linked to another non-performing loan by way of a package, and by that status is a non-performing loan.
Yeah, and I'll come to that point.
Yes.
So what errors might you identify that would result in loans being removed from the sale?
I don't think we could. I mean, there's 10,700 properties, and so I think to speculate would be unfair on this team. What I can assure you is probably three things. You know that there's a line of communication into permanent TSB. Many of you, indeed all of you, use it, and the team looks at every case individually. Secondly, if there has been a genuine error, whatever that means, then of course we have the right to take it out. But thirdly, just to absolutely emphasise what Eamon said, the loans that are in Project Glas at the 31st of March are NPLs. And they're NPLs really by dint of, number one, they're 90 days past due, or number two, they're unlikely to pay. And unlikely to pay includes those which you might define as performing, but which are connected to a non-performing loan, because it's the connection that is defined as the NPL, and they're the rules of the game that we play.
Are you agreeing any new restructures on loans that are included in the sale, or have you agreed any new restructures since the end of March on those loans?
We have, yes.
You have?
We have.
And can that continue?
That will continue.
That will continue?
Yeah.
So Permanent TSB can and is willing to enter into new restructures with customers whose loans are being sold right up to the transfer date.
That's right, and we're making our decisions in conjunction with the new owner.
What does that mean?
So, as we said before, the transaction was signed on the 31st of July, so we continue to manage accounts in the same way as we have done to date, and we're informing the new owner of the loans of those decisions.
Do you need their consent, or...?
We do agree with them, because ultimately those loans are for their account. So since the cut-off date that Eamon mentioned, the cash that comes in or not, as the case may be, is for their account.
So is it a kind of a joint decision on a restructure of a loan?
It's ultimately their decision.
Even now, before the transfer date?
Yes, yeah.
The contracts were exchanged on the 31st of July.
Yeah. So they could veto any proposed restructure that you wish to enter into with an individual customer between now and the transfer date. So they're really in control of the portfolio now in terms of any changes to individual loans at this stage.
So when an agreement is signed, that is the intention, and there are two phases to it. There's the economic phase, and once the agreement was reached at the end of July, the economic benefit is for the new owner, and you then have a period to the end of November, as Eamon said, where the legal transfer happens, all the due diligence and the final reconciliation happens.
And in practice, are new restructures being agreed?
They are.
Of what nature? The full suite?
So broadly, yes, I'm not aware of much diversion from the way permanent TSB would.
So including long-term restructures are getting the sign-off from start mortgages?
Yes, long-term structures, short-term restructures. So the business is running broadly as it always has done.
So restructures such as term extension
Yes.
and arrears capitalisation
Yes.
are happening, and happening with the support of start mortgages?
Yes.
I mean, Start Mortgages is a regulated credit servicer, right? So therefore it has to apply within the laws of the land.
Yeah, but that doesn't oblige them to
No, it doesn't oblige them,
offer
but-
any particular restructure.
But I think it's, in the same way that, that there are points quite rightly that you wish to make. I think it is important that the Governor of the Central Bank of Ireland has made it very clear that the protections travel with the loans, and that the regulated credit services operate within the laws of the land. And
Yes,
I think that's important.
But equally, they can say, and they can choose, that they do not do certain restructures. That's open to them. The code does not require an institution, a regulated entity, to consider all the restructures.
And again,
So I think it's important that we're clear on the message to the customers who are affected by this transaction, that there is still a window to agree a restructure of their loan between now and the end of November. And do you wish to put that message out there, that you're willing still to restructure mortgages? It will have to be with the agreement of start mortgages.
That's correct, and Jeremy actually made that explicit reference in his opening statement. And from the point of closure, start mortgages will clearly make decisions on their own basis. Equally, I would say they and other funds like them are known to offer solutions that actually the traditional or high street banks don't offer.
But are there transactions or proposed restructures that you have recommended which Start have refused to endorse?
I'm not aware of.
You're not aware of any?
I'm not.
Okay. When was the Minister for Finance alerted to the proposed sale in advance of the announcement at the end of July? When did the formal consultation take place as was required under the Relationship Framework Agreement?
Shortly beforehand. I wouldn't have the specific date in front of me, I'm afraid. Amy, is there anything you'd like to add? I don't think so. It was
In the month of July, or?
Yes, July, obviously before the approval, before the contract was signed, and it forms part of the board approval process, where the Minister's input is also part of that.
And what form did it take? The bank would have written to him and he wrote back, is that it? Or?
Yes, that's right. Obviously, this transaction was very much in the public domain as well. So,
okay. And the Minister raised no objections to the sale?
No, that's a part of the approval process, that the Minister would have no objection to the sale, yes.
Yeah, and I know it is the final decision.
There was no objection to the sale.
Yes.
Yeah, correct. No objection to the sale, okay. Yeah. And in relation to the removal of the split mortgages, which I very much welcome, you did at the time when you confirmed that indicate that you may be looking at a securitisation option in relation to those 4,000 plus split mortgages. Have you any update for the committee on that issue?
Probably a few things I'd say, maybe linked to the previous question and then moving on. So I'd also say there has been a definite increase in engagement with the bank since the announcement of Project Glas. And indeed, it has been noticeable the amount of conversations that have happened, the amount of cash that's been, I suppose, put to the mortgages. And so that's a good thing. And I think I'd encourage customers to continue to talk to us. So that's a good thing. In terms of further plans, we've said that we're looking at all options, including capital market solution. I'm not at liberty today to give any further detail, but we are looking at all options. As soon as we're in a position to make a market announcement, then we do so. And I say market announcement because market disclosures, when inappropriate, have really adverse consequences for the bank, the directors. So I haven't got anything further to say, save for we continue to look for further solutions, because as as you have collectively mentioned, we're at 16%, and that's an NPL ratio that's just not sustainable for a financial services business.
So one final question, Chair, if I may. I think one issue that people feel particularly aggrieved about is where their family home mortgage, which is in full compliance with the original mortgage contract, is being sold, or where there is a restructure which has been in place for a long period of time and they're meeting the terms of that restructure, but they're included in the sale by virtue of being connected to a buy-to-let loan, which may have been on interest only by agreement from the very beginning of the loan for up to perhaps 10 years, interest only. So just to clarify, those loans, those family home mortgages, they are correctly classified as non-performing even if a mortgage payment was never missed, because the owner of that home also has a buy-to-let mortgage which is classified as non-performing.
So we took the whole perimeter, the 5 billion. We made every effort to get to the best combination of NPLs that would get us the best result for the taxpayer within that construct. I've talked about the exclusions, and the exclusions are standalone PDH split mortgages. However, in the same way that performing loan, which is either up to date or performing as you might describe it as per the terms of restructure, that could still be included in Project Glas if it was part of a wider package containing an NPL or cross-collateralised with an NPL. The same is true of a split mortgage.
Just to clarify, a buy-to-let loan that has been on interest only by agreement from the very beginning and a payment never missed, is that classified as non-performing?
It depends.
Yeah.
If it has a classification that it's unlikely to repay in the future, i.e. where there's a fairly low value versus the actual outstanding loan, it can be classified as non-performing because of that unlikeliness to repay, or indeed where the customer, but by way of interaction with the customer, it's deemed that they will unlikely be able to meet their responsibilities. So it's possible, yes.
But I mean, the point is here that for a lot of these family home mortgages, they're going to be fully repaid 100%, and they're being essentially sold on as part of a bundle at a discount of 38%, even though they will be fully repaid. I mean, that's the cream on top of this transaction for the buyer for start mortgages. The perfectly good loans will be fully redeemed, fully repaid, and a discount of 38% is being applied in the aggregate.
I absolutely appreciate why you make that comment and inadvertently ask me a question. I'm afraid I can only go back to my opening remarks. NPL definition is complex. We are bound by the rules of the regulator who holds our banking licence. An NPL is an NPL if it's at its most simplest greater than 90 days past due or is unlikely to pay. And the team will have gone through the accounts, and any account that's got an unlikely to pay code on it itself would be in Project Glas. And then if it is in Project Glas and there is a connected account, then the whole connection is brought into Project Glas. And I'm afraid they're the rules of the game that we play.
Just finally, Mr. Masling, I mean, what would you say to your customers who have been loyal customers, who have been genuinely making their best effort to pay their mortgage, have engaged, have entered into restructures, to find now that their loan is being sold from under their feet? They feel very aggrieved. They feel that's very unfair, and they feel it's unnecessary. And I wouldn't understate the level of stress, anxiety, the mental health issues that this transaction is causing for a great many of your customers. And many of them have made the point to me that, look, was it really necessary? Their loan was well on the way to being reclassified as performing. And I'm not talking about the mortgages where nothing has been paid for several years. I've no sympathy in those cases, and there are certainly some of them, I would imagine, in this bundle. But there are a lot of good customers, loyal customers, doing their very best, making sacrifices, engaged, made agreements with you, kept their word, and are well on the way to being reclassified. Could you not have given those ones more time to be cured in the technical sense and be reclassified as performing?
I'll probably say two things. Obviously, this point has come up a lot in my or our attendances at the committee. From the letters I received from the people I talk to, because believe it or not, I don't sit in a gilded cage in a glass ceiling. I've been in front of customers all my working career, and I speak to customers. I'm acutely conscious that some customers feel really aggrieved that they have a loan that's meeting its restructure terms, yet it's included in the sale. And of course I can understand why they might feel this way, but there's two things. First of all, start mortgages are obliged to honour that agreement at the day of transfer.
For the duration of the agreement, yeah. Yep.
And then secondly, it's worth saying again that we spent a lot of time trying to get the maximum level of exclusions that we could. And so links to principal dwelling homes which are performing in line with an agreed restructuring and not connected, they're not in Project Glas. So I understand why you asked me the question. Words are meaningless, but let's say them anyway. I can try and empathise what I can. At the end of the day, we have a non-performing loan ratio which makes the bank quite risky for Ireland, to be frank with you, as the Governor talked about last week. It's important for Ireland that that risk gets diluted and potentially transferred. I have a duty to all Irish taxpayers, and I'm trying to balance all the different parts, and I'm comfortable that the team is doing that.
Thanks, Chair.
Senator Conway-Walsh.
And thank you for your opening statement. Mr.
Good afternoon,
Master.
Senator.
Sorry?
Good afternoon.
We met with the ECB recently, and obviously part of our discussion, a large part of our discussion, was around the non-performing loans, because what we wanted to get at was the extent of the pressure from the ECB on yourselves in terms of the sell-off, and we spoke in particular about Project Glas as well and the impact that was having. They made it abundantly clear that they were not in any way instructing the sell-off. Now, I think everyone gets it in terms of the reduction of the non-performing loans, but I think it's quite astounding that you have the list of options, and yet you have 5 options within that, and as my colleague Deputy Doherty pointed out, all of the options from A to K. Why do you think they're there if in the Code of Conduct, and if they're not being used? And are the ECB aware that you're using a very limited number of options?
I think it might help the committee if I try and just explain a couple of elements. The list of treatments which were read out to me by your colleague were from the regime that we were under with the Central Bank of Ireland, where our governing objective was to find as many long-term treatments as possible. Irrespective of whether we've done them or we didn't do them, all of those treatments would mean that those loans are still NPLs.
But why aren't you using everything?
All of those treatments are NPLs. So then let me answer your question. All right. So the second question is around the ECB not being prescriptive in terms of what we can and can't do, and that is true. Right. That's absolutely true. But our NPL ratio is totally unsustainable, and it's dangerous for Ireland. So I think I can say that as a guest in Ireland. I think I can be perhaps more objective than most.
Can you
our
explain
NPL
how it's dangerous for
NPL
Ireland?
ratio is really, really dangerous, and we need to spread the risk.
Just explain that, how it's dangerous for Ireland. Just explain that a bit further.
Because the risk of the assets, if there's another economic shock, those assets are likely to be assets that will cause us real difficulty in terms of our capital base. Banks need to have low NPL ratios. It's a regulatory requirement for us, and I quote, to have ambitious but credible. They're the words that are used. Plans to reduce NPLs, and PTSB is an outlier, and therefore we have to look at all alternatives. In my opening remarks, I explained to you the different alternatives that we've considered, and we're very clear that a loan sale is the least worst alternative. And I suppose there's one data point that I asked the team to get me, which I thought was quite interesting, actually. I asked the team to get me the historical Irish average of bank NPL ratios. in the 90s and the 2000s, just to get a comparator, because at a time when we're talking about NPL ratios, and it was less than 1%, right? Ours is 16. So I just think we need to all take a step back and agree what we're trying to do here. So from my perspective, I'm trying to do the right things for the taxpayer. And as I have a quote somewhere, I think, from last week.
But don't you think that the banks played a big part in that, and banks like yourselves, in terms of reckless lending in the first instance, and then in terms of people losing their jobs and being put in the financial situations they've been put in because of the nationalising of the private debt of the banks?
Well,
This isn't, we have to look at the causes here. Why the level of non-performing loans is as high as it is, and the banks played a very, very, very active part in that. And now you're coming along, and this is, see, what really gets to me is now you're coming on. You have a suite of options there, and you're deciding, well, no, we're not going to use 5 of them.
But they're still
and that's
NPLs.
What I have the problem with.
Sorry, that's the point I'm making. Apologies if I'm not making myself clear. Those suite of options are long-term treatments. If we go back in time, in 2012, the Troika, the Irish government, and Irish public policy decided that the banks must avoid scale repossessions. That was the policy decision. And as a consequence of that, the Central Bank of Ireland asked all banks to put in place long-term treatments, which Shane has been at the vanguard of. The point I make is that in this world we live in, those long-term treatments are still non-performing loans. Just because they're treated, it doesn't mean they're not non-performing loans. They're still non-performing loans. That would be the first point. The second point is a non-performing loan ratio of 16% for a state-owned Irish bank. As the Governor said, the transfer of credit risk and funding risk to investment funds to buy loan portfolios constitutes a national reduction in macro financial risk. And that, for me, is a really critical point. So we have run out of options in terms of reducing our NPL ratio. We've looked at all the different alternatives, and as I say, the loan sale is the least worst alternative on the basis that the protections.
Mr. Masding, yeah, I don't think that you have, so I don't share your opinion of that in terms of enabling people to have security within their own homes and to give people a chance. But I want to put a couple of other things to you.
Yeah, of course.
Just because we have a limited time here, did you speak to Smart Mortgages about their non-attendance here today? Did you have any discussion before today? At what point did you know that they weren't going to be here with you? Because I think for us to have yourselves here today and to have them here would give us some reassurance, or we could have some guarantees on public record from the organisation that you're passing these loans to.
I haven't spoken to Start Mortgages, and neither would I want to. I can't put myself in the shoes of Start Mortgages.
Does it concern you?
I beg your pardon?
Does it concern you at all?
I make no comment. I looked it up this morning. I think this is the 12th time I've been in front of this committee, other than when there was a closed period when I actually couldn't come legally. I have been here every time that you've asked me. I will continue to come because I think it's an important part of the process.
You see,
so from my perspective, if you don't mind, I'm not going to put myself in the shoes of Start Mortgages.
Yeah, but you can understand from our position, you see, that we're given these assurances that everything is going to continue the same, and the same from the Minister for Finance, that there's no concerns here, and yet they won't appear before an Oireachtas committee. So what do they have to hide? And that's what rings alarm bells with people, and people who have these loans, and how they're going to be treated in the future. So if they treat an Oireachtas Finance Committee in the way that they do, how can we expect them to treat a homeowner with any respect? That is the question for us. When is the last time you met with the Minister for Finance?
I meet with him regularly because he's 75%. He's my largest shareholder, obviously. I meet with him regularly to discuss anything ranging from, performance, mortgage market share, NPLs. I would have met him on part of a regular cycle maybe a month, 6 weeks ago, probably.
Okay. And he has no concerns whatsoever in terms of how you're choosing to reduce the NPLs, no?
I can't comment in terms of Minister Donohue's perspective. I'm just going to bring it back to permanent TSB. My job is to get the best deal for all Irish taxpayers, and that's what I continue to try to do.
And for the people who are in their homes at the moment. Are you concerned that smart mortgages may decide to flip these mortgages on to somebody else, a non-regulated entity? Or have you discussed that within the transfer arrangements?
That's a hypothesis. I'm not going to speculate this morning.
So it's basically up to them to do what? So really we have no guarantees, because they could make that decision. There's nothing whatsoever from restricting them making that decision to flip them over at any time.
I think that's an unfair question. I'm not going to speculate on how Start Mortgages run their business. What I do know is that this bank has avoided enormous repossessions. I know that this man here has spent the last 6 years of his career working with customers to try and find long-term solutions. I know that I'm a regulated entity. I know that the European Central Bank holds my banking licence. I know it's important that PTSB competes and provides finance for the next generation of homeowners. I know that we've looked at all the alternatives, and I know that the loan sale is the least worst alternative, and I know that the Governor has assured this committee that the protections travel with the loan. That's all I can say.
Can you see from our point of view, you see, you're giving us reassurances that, the homeowners are going to be protected. And really, when you scratch the surface, they're not going to be protected at all. So they're certainly not going to be protected from the flipping over of the mortgages to somebody else, and they won't even come before the committee. So you can see where our concerns are coming from. I just need to get again to because I'm really concerned about this, where you have the performing loans, homeowner paying their mortgage diligently, may have bought another property and being enticed by the bank to buy another property, mind you, during the boom and all that, and then have got into trouble with that mortgage. Are they two separate contracts? If somebody has their home and then they decide to buy another home, are they two separate contracts?
I fear I'm going to really annoy everybody, actually, because I suspect the worst witness that you have is someone who just keeps repeating themselves.
No, I know but really, just indulge
First
me.
of all, I just want to apologise, because I'm afraid I am going to be a long playing record. I don't know what else to say. This is a regulated bank. A regulated bank is defined by its banking licence. Its banking licence is given, and it has to apply the rules. The rules of NPL definition are given to us. The rules of NPA...
I know. Please don't. That's not the question I asked you. The question I asked you was around the details of the contract.
The rules of NPA definition say, even if there are two separate contracts, and one of them is an NPL and they are collected either through cross-collateralisation, right, or cross-default, one's gone into default, the other one hasn't, I'm afraid that the rules say it's the connection that becomes the NPL. So I'm sorry, Senator, I don't really know what else to say.
I just think that's grossly unfair, and I think it puts people in a very precarious position. They've been enticed in the first place, in many cases, into investing rather than a pension in a separate property, and now their own home is at risk when the mortgage is being sold off.
So the best thing I can do then is I acknowledge your comments, and I hope you would do the same for mine.
But I'm just, I'm not reassured. I want to ask you, what have you done with the properties around the buy-to-lets that you've taken back?
So they are known as properties in possession. The bank is not a property company. The bank has an obligation to put these properties into the market as quickly but as sensibly as it can. So with that as context, Shane, perhaps you might just give a bit more detail, if you agree with that as context.
I do, yes. Okay. So we're actively selling those properties. So far this year we've sold about 500 properties. We have a stock of just below 1,800. 330 of those properties are currently at sale agreed. There's a further 400 properties that are for sale at the moment, and there's a further 400 that we're preparing to sell. So the bank is actively looking to put those properties back into the market.
Did you offer those to government to form part of the housing solution?
We've been speaking to the housing agency, so they're actively looking at a number of those properties.
Have they bought any of them?
Not yet, but we are moving close, we hope, to an agreement on a portion of those properties.
And are you selling them at a discounted rate to government?
We're selling them at market price. It's our obligation to secure the best price possible on behalf of the borrower, so that we can minimise any shortfall if there is any upon sale.
But the borrower is out of the picture at this stage.
But
obviously, they're the assets that have been reclaimed,
yes,
and you're owned by, are mostly owned by the taxpayers, so by citizens.
That's right.
By
So
government.
in totality, the 1,800 represent properties that came back through the voluntary surrender campaign and more generally. So the onus on us is to secure the best return for our shareholder, which in large part is the state and is the country's taxpayers. So we're looking to sell those properties at market rates.
Would you see that you have an obligation to contribute to the solutions of the housing crisis because of the part that banks like yourselves played in the housing crisis in the first instance?
I think practically what we can do is put these properties, the 1,800 that we have at this stage, back into the market as quickly as possible. That's something we're actively doing, whether those properties are vacant or whether they're tenanted. If they're vacant, they tend to work for first-time buyers and trading up buyers, and if they're tenanted, they'll work for people who want buy-to-let properties. So I think that's our duty, and that's what we're doing as expeditiously as possible.
And is there any protection in there for tenants then? So if you're selling off, with a tenant a property that has a tenant living in it?
Yeah, so we'll honour the tenancy guidelines, so absolutely that is our duty, and we adhere to that.
When did you start offering these properties to government?
From recollection, around March, I would say, of this year. Don't hold me to that, but early part of this year, I would say.
And none of the purchases have been completed by government?
No, not yet. So we have a substantial number of offers. They've been approved by permanent TSB in principle, but through then to actual execution, we're not there yet. But
so we're 8 months out. We're in a housing crisis. And you offered them to government 8 months ago, 8 months ago, and they still haven't completed any transaction.
Again, I think that's a question for somewhere else. Our duty is to offer these properties to different interested parties, and that's what we're doing.
Yeah, I mean, I think that's something, Chair, that we need to take up. If it's taken, it's no wonder we have a housing emergency. If it's taking 7 to 8 months to reach agreement on some of these properties when we have 10,000 people homeless, I think it raises wider questions there. I just have to refer finally to your comment around the rating agencies like Moody's have welcomed the move. Moody's? These were the ones that told us that Anglo in 2008 sounds profitable and good credit quality supported by rigorous lending approach. And you tell us that your actions are approved by Moody's? Do you not see the irony?
I mean, I can't comment on your perception of the rating agencies. What I would say,
it's not my perception, it's the fact of what their assessment of Anglo was.
I wasn't here, so I can't comment. Perhaps the rationale for explaining why I put that comment in there. At the end of the day, what we're trying to do is make the bank safer. If the bank is safer, we get access to a broader base and probably better value funding. If we get access to a broader base and better value funding, it means that we can support the next generation of Irish homeowners, and that's how the whole thing connects. So the point of principle is around trying to make banks safer. I make no comment on your observation around Moody's. That's not for me to say.
I wouldn't say an endorsement by Moody's is an endorsement that carries any weight. Thank you, Cahill.
Thanks, Senator. Senator Burke.
Thanks, Chairman. I'd like to welcome Mr. Masding and his colleagues as well to the committee. Just in relation to the definition of an NPL, you said that even if you have a family home and you have a buy-to-let and the buy-to-let is in arrears, that both are deemed to be in arrears. Is that the definition of...
They're both deemed through the connected clause to be non-performing loans.
I suppose the performing loan is with your bank and the non-performing loan might be with a different institution. What do you do then?
The definition that I give you, unless my esteemed CFO corrects me, is where both assets are with permanent TSB.
If there were different banks, we would not have knowledge of the performance of the loan with the other bank.
You would?
We would not.
No.
So they are not connected in the eyes of us. It's only where the two loans are with permanent TSB that the connection is formed. Not if it was two different banks, because we would not know the relationship a customer would have with another bank.
So the central bank have different views on people that have loans in both institutions or one institution. Would that be the case?
It's a question for the central bank, but we can only classify our mortgages for customers that we have loans on our books with.
I see. So you could say that a person that has a house and that the loan is performing, fully performing, that they're treated very unfairly by the central bank. In this case, where they have the buy-to-let as well, and they have the two loans in the one institution, that they be treated very unfairly compared to somebody who might have two loans in two different institutions.
That's a question you should ask the central bank.
Well, did you ask the central bank that question when you?
Well, I can't comment on the central bank. Again, I'm sorry, I'm a long playing record, but I have to come back to the rules of the game that we play. The rules of the game are, if there's a connected account within permanent TSB, they're non-performing loans. Okay.
The fully performing loans will say, what's the write-down of those, of the performing loans?
I can't give that data. I go back to my original comment. We signed a contract on the 31st of July, and within that was a non-disclosure agreement. I can't give that information, I'm afraid.
Well, could you say that the write-down of the performing loan is different to the non-performing part?
I don't want to get into a conversation that might take me to a place which breaks that confidentiality agreement. I can't give that information. All I can assure the committee is at the time of the day of the data tape being cut, which was the 31st of March, subject to the comment that we made to Deputy McGrath about sort of final technical reconciliation, all the accounts in there were non-performing loans.
Deputy McGrath said that there was a write-down of 38%. I presume that's right across the whole portfolio. Would that be the case?
The consideration price as opposed to the book value of the loan, it's 38% discount overall, yeah.
But you're not at liberty to say whether the non-performing part is bigger?
The only information, when you do a transaction like this, there are market conventions, there are also market abuse rules. The information that we can give this morning is that information we have provided to public markets. We haven't provided that information, and therefore I can't do that under the non-disclosure.
What about this person that's included in the sale? Are they notified of what the write-down is of their loans? So if a person is in there, their loans are purchased or they're sold off to a vulture fund, will the bank tell them how much the write-off, how much the write-down is?
No, because for instance, we would not know how the fund would look at each loan individually. That's their business. But as Deputy McGrath has outlined, the average, we know what the price for all of the book is, not individually. We don't know by individual loan. So that's the reality.
And we should be clear, that's the bid basis of which we get the written bid.
That's how we receive
the offer. You get it as a
one price.
At one price, yeah.
As one price?
Yes.
So you give to the people that are tendering, we'll say, for the loan portfolio, you give the individual amounts to them, how much is owed in each case? the property and how much is owed on it. Would that be the case?
That's correct. They would have, under
they may-
non-disclosure, they would have details of each loan, yes.
Of each loan?
Yes.
And they'll make a bid on what they think, on a global, or...
That's correct.
Obviously, they probably have analysis that they have internally, but we've no access to that. It's one price for everything.
So the bank have no knowledge at all of how much to write down individually might be?
Correct. That's right.
But the people that are buying the loans would, more than likely?
Naturally, I would suggest they would, but that's their business. We just get one price.
Yeah. A member of the committee here wrote to you in relation to a person that has a non-performing or has a performing loan and never missed a payment, and they had another loan, a second loan, and for some reason, which was the bank's fault, it went into arrears, and which was rectified after a couple of months. But this guy has been notified that his loan is being included in the sale, and the bank are saying they can do nothing about it. Now, you have said here on a few occasions that you're still dealing with individual cases right up to the finish, but the deputy, who he may be here later, has asked me to raise this issue, and he has written to you in relation to it, as well as the individual themselves. So it would seem that you're treating everybody in a global...
So as per my opening remarks, I can't comment on individual cases. What I would say is that there is a very professional team in permanent TSB who look at each of the cases. Either myself or one of my colleagues will come and talk to you afterwards, and we'll take the details and go and have another look. I'll show you that. But I can't come on individual cases.
Grant, thank you very much in relation to that. You say that there's 7,400 loans relating to the family homes and 2,500 are non-performing. So that means that there's up to 5,000 performing loans being sold off at a discount. Would that be the case?
Sorry, say that again.
There's 7,400 loans, we'll say, which relate to the family homes. But 2,500 of those are non-performing. Does that mean that
no, they're all non-performing loans. So again, what have we disclosed to the market? We should start there. We disclosed to the market that Project Glas includes approximately 10,700 properties, right? 3,300 are buy-to-lets and 7,400 are PDHs. Then we stated that of the 7,400, 2,500 of those are non-cooperating and 3,850 are cases where treatments had been refused or were no longer being adhered to. So they're all non-performing loans. That's the breakdown.
But they're categorised because maybe second loans. Would that be they're being categorised as non-performing because of other loans?
No. They could be categorised because they're non-performing loans in their own right.
And how many? There's 1,050 loans that are
the only information, the information we've given to the market again is 10,700 properties, 3,300 buy-to-lets, 7,400 PDHs. Of the 7,400 PDHs, there's 2,500 who are non-cooperating, 3,850 where treatments had been refused, and that essentially leaves you with a shortfall in inverted commas of 1,050, which Deputy Doherty asked me about, and the 1,050 are originally buy-to-lets where the connections changed to PDHs, but it's a non-performing loan. It's classified as non-sustainable, and the average arrears there is greater than €90,000, or it's a PDH which is in long-term arrears. So that's the breakdown.
Yeah, because, well, I'm sure I'm no different to other members of the committee here. I've got several letters from people who have performing loans, and for one reason or another, I suppose maybe some of them may have a second property or whatever, but the family home has been paid in full at all times, and they're very disappointed that those are included. Now, you say that the central bank is the cause of that.
No, that would be a bit unfair on the central bank, right? because I suppose I make 2 points. The first one is we're a regulated entity and therefore we have to do by the rules of the central bank. But there is a second point, which is irrespective of whether we were regulated or not, let's just hypothesise for a second and say that there was no regulation of the banks. The board of permanent TSB, including its chief executive, would still be trying to reduce the ratio of NPLs because, as I said in my opening remarks, a high NPL ratio is wholly unsatisfactory for permanent TSB in the long term. So, yes, there are some rules, but I don't want to get into a place where I hide behind the central bank. Right? Irrespective of the central bank, I would still be driving the organisation to manage down the NPL ratio.
But you have categorised a lot of those loans that are being fully performing, but you have categorised them as non-performing because of a second loan.
No, in my opening remarks, I was very clear, and again, I apologise, I'm going to keep saying it. There are no performing loans in Project Glas. A performing loan is a loan which is up to date and it has got no connection to another loan which is defined.
But the connection to the second loan.
There are no.
That's
there are
the
no
definition
performing.
From the central bank, is it?
There are no performing loans in Project Glas. They are all non-performing loans.
That's the definition of the central bank that makes it non-performing because it's.
That's correct. That's correct.
It's the central bank that makes that decision.
Correct. But even if they weren't there, I'd still make the same decision because if you have another loan which is non-performing, then you'd have to say, on a probability basis, that all the debt is in a category which would fall into unlikely to pay.
But you have sold off some properties, second homes. You have sold them off. If people handed over the keys to you, you said that there that if they handed back the keys. In some of those cases, is it how they wouldn't where they're not performing, we'll say, or they're second homes that aren't performing, where they're paying in full for their primary home, but they're not paying in the second one? Is it how they won't hand back that property to you? Or is it how you've taken the view where we're going to lump the two together?
The two things are separate. So the voluntary surrender campaign was done in advance of the sale, and we offered a large number of buy-to-let customers an opportunity to return the property and have the shortfall written off. And that happened and completed, and that's different to what Jeremy has just explained. You then have what's left, and the bank is obliged to follow the rules that it's obliged to follow. Jeremy has explained them, and those loans in the connection that he described make up the 25% NPL ratio, now down to 16, that we've talked about. So the bank is working through the end of that transaction, the 25 down to 16. That's different to the voluntary surrender campaign, which we completed.
And at all times you have engaged with those people in relation to where they had two properties, we'll say, and where you were offering them the possibility that they could hand back the second one. You engaged completely with them.
So we engaged with a large number of buy-to-let borrowers about their single property, or if it was appropriate, multiple properties that they had. And we offered them the opportunity to return their property for customers where we felt that was the best outcome for those customers. And just over 50% of those borrowers accepted that proposal.
Now, why would you think the other 50% didn't accept the proposal?
I don't know. I guess they felt it didn't make sense to them for whatever reason. It's their call, but the offer was very simple and very clear. In return for... And
now they find themselves included in the sale. Would that be the case?
Yes, there would be customers that will fall into that cohort, yes.
Okay, thanks.
Deputy Burton.
Thank you. And thank you for your statement, which I have to say I find extremely interesting. I just wanted to ask you about some elements of the statement, if you could perhaps enlarge on some of the statements in the statement. On page 2, you offered the example of customer A and customer B. One is paying in full, whatever the mortgage is, and the other has clearly difficulties and is not able to pay the mortgage in full and on time and according to the conditions. You basically say towards the end of the page that the same problem arises in respect of individual deal arrangements. All customers will not be treated equally. It's a real moral hazard. Now, in the context of a lot of the previous discussion, I think it might be helpful to us if we could understand, or certainly if I could understand, what the bank's definition of moral hazard is, and in particular, what's a real moral hazard. Is this an ethical concept? Is this a financial concept? Is this a social concept? I think it's one of the clearest statements I have ever seen by a banker, with examples attached of what moral hazard is. But I have to confess, I still don't fully understand it. So if you could start by defining what you and your bank mean by real moral hazard.
I'll do my best. Good afternoon, Deputy. First of all, I just want to reiterate the difference between debt write-off and debt forgiveness. So debt write-off is what I would define as traditional banking. You lend money if a customer finds themselves in payment difficulties. You do all you can to try and help that customer. Sometimes that means that you're unable to find a treatment, or it's in the customer's best interest that they return the collateral. If when you've got that collateral, the value of that collateral is less than the loan which is outstanding, you have a shortfall. And then a bank has a choice as to whether it chases that shortfall or whether it writes it off. And in the case that Senator Burke talked about of the large buy-to-let voluntary surrender campaign, then we determined beforehand that what we would do would be to write off the shortfall. That is what debt write-off is. Debt forgiveness is where you create a situation where essentially the bank is having to choose between two customers about how it uses its capital. And that is not for the bank to do, because on the one hand you have a customer, as I described here, as customer A, who continues to make their repayments. And on the other hand, you have customer B, who has been unable to, and essentially we reduce the mortgage owed to them in a unilateral basis. That has a moral hazard, I think, for two reasons. One, if the customers live next door to each other, you create the moral hazard around the relationship between those two people, because one of them is saying, okay, well, I work really hard to pay the mortgage, and yet you're in a situation where the bank's written you a cheque. That creates a moral hazard because it creates a knock-on effect. And secondly, it creates a moral hazard for the banking industry, because if the bank does that for one particular customer, you then have to ask yourself the question, well, why would you not use capital to do that for all customers? Therefore, that takes you to the final place, which is the responsibility of the management team is to use the capital that was given to us, the 4 billion by the Irish state, in the most judicious fashion. And I couldn't countenance debt forgiveness, moral hazard, and the use of that capital as something that permanent CSB would do. So that's my best effort to answer the question.
So in referencing there the Irish state, you, in a certain sense, imply that you recognise, if you like, a social dimension to moral hazards. In other words, that they affect or have an impact on the Irish state. In other words, would you agree with me that that means it affects Irish society? I
think I'm right in saying that you yourself as an individual was right in the middle of the Troika negotiations and the Troika issues back in 2012. I come back to linking moral hazard to avoiding repossessions. At the time, the Irish state had a choice, and the choice was, from a social perspective, that all the banks avoided scale repossessions. And from a social perspective, in terms of contributing to Irish society, I would argue, you may not agree, but I would argue that the long-term treatments that have kept people in their homes is a huge contribution to Irish society. I'm not sure you'll agree with me on this, but the unilateral use of capital to individual customers is not in the best interest of all Irish taxpayers, and that is not something that certainly on my watch I could countenance.
Well, just let me say, I was not the recipient of a Jesuit education. I don't know whether, you know, some of the people in the bank's board and that were. I didn't have the benefit of that particular form of education. But moral hazard, I think, is something that the Jesuits as an order have spoken about over a long period of time. So what I'm trying to understand is, if this is a moral hazard in your construct, and you've acknowledged there's a social dimension to what we're talking about in terms of impacts on society and obviously impacts, as you've described, on, let's say, customer household A and customer household B. What I would like to know is that, you know, again, just taking that broad moral hazard construct, do you think that the issues around the housing crisis and the consequences, for example, for people who are forced to vacate home, do you think that that constitutes another type of moral hazard for Irish society, in the sense that certainly at the moment in Dublin West, my own constituency, where you have quite a lot of customers and even active banking presence, there are just at the moment really no replacement properties available for a lot of the families who may be the ultimate workout people affected by your moral hazard construct. So I'm just wondering, in that Jesuitical sense, is there also a social construct which says that, in fact, a level of debt forgiveness may, in fact, be reasonable in the context of how the situation arose, and secondly, in the context that the consequence for the people who see the working out of this particular doctrine may in fact be extremely difficult for themselves, and particularly if there are small children involved in the family who, you know, have a great deal of stress. I mean, I don't advocate anybody not paying their mortgage. I mean, I think a lot of people around this table have struggled to pay mortgages, and we've paid them in full. I'm sure the people on your side of the table have the same framework and approach. So I think that's a kind of a shared view it's likely that we all have. But the level of the crash, I mean, I stood in queues because, you know, at one stage and still, I had bank accounts with the TSB in Blanchardstown. And, you know, people were queuing up at that time, this is 10 years ago, to arrange and finalise deposits and so on properties that their children were purchasing and parents were doing their best. But, I mean, people were really not advised by your bank or by other banks as to what they were taking on. Now, that if in a certain sense, is their own problem. But I would say the bank actually created quite a bit of the moral hazard, the banking system, in the sense that it popped up loan offers in the door, out the door, anywhere, to say, no matter how limited your income is, you can get a loan. Now, that's the past, and that's what happened. But what I'm interested in is, I understand all the economic arguments as to why you're offloading all of this, but I'm just worried, given that you make such a really strong statement about real moral hazard and the implication in this, that it's really bad. It's bad for the bank, it's bad for people, it's bad for society. Does that not mean that you, in the moral hazard context, are under an obligation to actually seek out to assist people? Instead of which, I want to put this to you, as has been raised by my colleague here, and as I know myself, and I know to the distress of a lot of your staff as well, people who did make arrangements and agreements with you and faithfully worked, in a lot of cases their backs off, faced intense mental stress at different times, family illnesses, possibly partly contributed by this, but they are in jobs. For example, they could be working in a public service job where actually, provided their health holds up, the continuing payments are pretty close to being assured, even if it's the workout and so on is longer. What I don't understand is, can you not show some compassion to those people? I understand that they're not perfect borrowers, but the crash was not a perfect crash. It crashed on top of people who may have lacked foresight, may have lacked an economic education because the bank threw the money at them. So, I mean, as you're, and I realise you kind of came into the bank, you know, sometime afterwards, but I don't get this moral hazard which does not have a wider social construct around it. I mean, like, I know this is an ethical question, and I know your bank has statements about corporate social responsibility, and I think seeks to have an ethical framework. So what would be wrong with the bank continuing the workouts? Like at the moment, as you said earlier, you're giving a 38% or so discount to the mortgage company that you're selling on to, ultimately to Lone Star. That's a really big discount. In a lot of cases I know, and we can ask some of the colleagues here in relation to the cases they know, even half of that discount would actually obliterate the problem. So why is it not possible, where people have been really trying and where they are in work, and you have a defined, you can see that there's an income going to come in, say somebody is around 45, they have at least another 15 working years, maybe a bit longer. So, you know, you don't need a crystal ball to predict that this family are committed and that this family are trying. Why is it not possible? And see, this is it the moral hazard argument is preventing you hold on to that family? And I mean, have you, for example, written ever to the European Central Bank to say, well, look, the people who never pay at all, make no effort, we really don't, you know, we really can't actually deal with them. We're handing that set of people on. But I'm talking, as other people have said, about the people who've really tried. And now they seem to be found guilty in the court's bank of opinion of this real moral hazard. Like, you know, can you just enlighten us? How do we deal with this? How do we address it?
3 or 4 points. First of all, it would be fair to say that my experience of secured lending or mortgages is, as I described to some of your colleagues, you lend the money at a point in time based on affordability. It's secured lending, so therefore it has a certain price. You engage in a relationship with a customer. If the customer unfortunately finds he or she in a situation where it's difficult to pay, you do all you can to try and help them. You then get to a situation where actually the arrears are at such a level, or you are in a situation where it's just unlikely to pay, that you repossess the collateral, you sell the collateral and you put it back in the market. That's a banking model that I, for one, would be very used
But in
to.
the United States, if that happens, the home of capitalism, in the United States,
Well,
what you can do is leave the keys in the door and away you walk as well from the obligation in total. So you do lose your home and it's dreadful, but actually you don't carry the debt like a hump on your back forever after.
Can I answer your question? So mortgages in Europe are not generally designed like that, so that's a different question. So there is a huge crisis in Ireland, as you know. We have a conversation in 2012 where actually, if you'd applied the banking model which I described, there would have been thousands and thousands of repossessions. So the first point I would make is that permanent TSB, and indeed all my colleagues in the other banks, set out to avoid scale repossessions, and I think the data would support that. That would be the first thing. Secondly then, as I've described, a large non-performing loan ratio has enormous impacts for the bank, and it also has impacts for future customers, because the capital markets perceive that the bank is more risky, and therefore the cost of capital to us becomes higher. So therefore, what's the next best alternative? The next best alternative is to undertake, to the best of our ability, a loan sale where the protections travel with the loans, and the buyer is there to, at a point, at the time we sell the loans, there are treatments and they will be maintained. The third point I would make, and again that's the point I'm trying to make, is that debt forgiveness for me is essentially me having to choose between different customers, and I'm not in a position to do that. My job, we might disagree, but my job is to get the best return on capital that I possibly can for all Irish taxpayers. I believe that the long-term treatments, I believe that the loan sale achieves that. I think your question has some broader connotations. It has connotations around housing supply. It has connotations around the role of Irish society against it, and I can't comment on that. I think we have done all we can within the boundaries that we were given. This man put in place many long-term treatments. This man designed a loan sale that was the best construct that we could come up with what we had. So I suppose I'd summarise. Moral hazard is where I'm having to choose between customers in terms of using capital. And debt forgiveness actually forces the bank to make that choice. And that is not for the bank to make that choice, because it's all the taxpayers' capital.
Well, can I just ask you then about your statement on the first page, which again I think is very interesting. 10 years on from the start of the financial crisis, and as many commentators say, and you're saying it here, closer to the start of the next one, the next crisis, than the end of the last one. So in other words, in the bank you're envisaging already the next crisis. But I mean, at the moment, in terms of, as it were, releasing some of the pressure of the crisis, what has been happening is that in fact capital values, as you know, on what really were very overpriced properties that your bank offered a mortgage on. I mean, with hindsight, I suspect you would even agree that many of the properties were actually heavily overpriced. Now, the individual customer is really not a market maker. They don't have that power in the market. But if we're now closer to the next crisis, and if moral hazard is your ethical framework, I think it's reasonable in terms of people who are in the housing market. And you know, you've quite impressive statistics there about your new lending, the plus £500 million in the statistics that we were given. So if interest rates are slowly but surely rising, at this point in time, given what you say you've learned from the last crisis, what, if anything, are you doing to protect, you know, those people who are, you know, the people in the statistic on the total new lending? Because I don't know, does the bank expect interest rates to rise, or what, you know, you're saying there's a next crisis. Can you just fill us in on your view of that, and in particular in relation to people taking out loans? You know, what is it? Is it that you expect interest rates to rise? That could make them just as affordable.
Sorry.
No, I'm
Was
reminding the
coming to me.
Deputy over
Oh,
time.
sorry.
If you
Yeah,
would
so
answer.
very quickly, I suppose there's 3 points I'd make. Can I repeat what the Governor of the Central Bank of Ireland said, that in terms of national risk management, the transfer of credit risk and funding risk to investment funds constitutes a national reduction in macro-financial risk. So I suppose, in its broadest sense, we're contributing to the diversification of that risk. In terms of individual customers, we, I think, have raised the standard, as have all my colleagues across the banks, in terms of underwriting. It's a lot, I think, more focused on affordability as against a belief that asset prices only go one way. And then thirdly, in terms of the product portfolios we have, customers can make a view on interest rates, and should they choose to want to have a certainty of repayment, we offer fixed rate mortgages. So I think in terms of what we can do, we're using all the tools that we can.
But can I just ask him very briefly? There's a very big statement there about the next financial crisis.
I understand that, but the others had very big statements as well, and they all got 20 minutes. So
Okay.
yes, you can ask one more question, and then we'll deal with it.
It's just about, could you expand on the next financial crisis? It's so clear there on the front page. It's a very striking statement, like the moral hazard.
It's a function of external commentary. There is commentary out there across the globe that, you know, so for example, a trade war between America and China, Brexit, they're all indicators that one should be very conscious that there could be the next financial crisis, and so therefore I have to bear that in mind as I run an institution which in itself needs to be very conscious of risk management. Sorry, Chairman.
What?
Thank you.
Did I go on too long then? Was that me? Okay.
Senator O'Donnell.
All right. Sorry.
That'll come later. I just a few very quick questions. Afternoon. When you restructure a loan, what do you regard as a functioning loan? So, say I have a loan of 200,000 and they're in arrears, and you restructure that loan. What do you regard as a restructured, functioning loan?
There are many degrees of a restructured loan. So there can be a very simple restructure that is trying to address your problems in the short term. And then there can be very deep restructures where it's obvious that affordability won't be present for quite some time, and there's a deep restructure. So some of the products and the solutions that you hear about, like the split mortgage, recognised that 10 years ago Ireland was in a very difficult place, as we heard the Deputy say, and it didn't look like it was going to resolve itself anytime soon. So the conventional restructures that might have been in place at that point were largely irrelevant.
I tell you, and I'm Chairman, we were with the ECB. We did a trip to Germany quite recently, and part of that was we met with the ECB. And we met with their officials, and we did a bit of, I suppose, digging deep on what they regarded as restructured loans. And I put it on the record, they were quite offended that they were being blamed for, or they felt they were being blamed for the Irish banks being put under pressure to bring their non-performing loan ratio down in rapid fashion. In fact, they took grave exception to it. They were highly offended collectively across the group. That's number one. Number two, what they told us was that on a restructured loan, that if you split a loan, their definition of a restructured functioning loan was putting a loan in place after the restructure that was people could meet their repayments. So the example would be €200,000 mortgage, 150 of that can be that the individual can afford. So 50 of it they cannot afford. So they spoke about junior and senior. The senior would be the 150. They weren't even concerned about the time period of the loan, so long as the person could meet the repayments on that loan. And the 50,000 element of it, which is the junior side, as far as they were concerned, that had to be fully provided by the bank. And they would deem that, so if you had €200,000 loan, 100 of it could only be sustainable, then 100 of it would be senior. You could put it over whatever the individual can afford. It could be 15, could be 20 years. The 100 then would have to be junior, fully provided, full write-off. So is that your understanding? And you might address the fact as well, Mr. Masting, that on the issue of they felt that they were being the fall guy for, I think maybe some of my colleagues would disagree, but I think that's a reasonable assessment. They felt that they were being the fall guy, being treated, or the fall lady, being treated for the banks selling to funds. They said they have not come under, they are not the bad guys in this, and they do not wish to be treated as the bad guys or ladies on this. And to say that they were offended would be an understatement. So you might just deal with their point that it was a very interesting meeting. It was a high-level meeting at every level, and they have concerns around permanent TSB, which I expect is nothing new to Mr. Masting in terms of how they view the bank. So you might just address that and just, I suppose, the practicalities. Mr. O'Sullivan on the restructure and Mr. Masting on the macro in terms of the bank.
Yeah, on the macro, I would absolutely understand if they were extremely irritated if that was the perception that they were getting. And in fact, I would be extremely disappointed if they felt that there was a relationship between my team and our regulator that actually ever even gave that impression.
You made a point, Mr. Masting, that unilaterally bringing this up at the start of our meeting. We didn't ask this question. They brought it up themselves. This was the ECB in Frankfurt.
No, and I'm saying I would understand.
Saying that they did not want to be put into position that they were the people that were causing the banks to sell to the funds, to bring their non-performing loans down at an accelerated rate. As far as they were concerned, and then we got into the space about the split mortgage and the affordable and functioning mortgage. So you just might address those, I suppose, both yourself and Mr. O'Sullivan address them.
Yeah, of course, Senator. What is factually correct? Factually correct is that there are outlier banks who have very high non-performing loan ratios. The second fact is that permanent TSB is one of those banks. The third fact is that, absolutely correctly, the regulator has insisted that those banks provide, I think the phrase is credible but aggressive, NPL reduction plans.
Have they set targets?
The next fact is that at no stage have they made any judgment or direction about how the bank should do that. Lastly, there are no targets. I mean.
No, but this is a very critical point.
No, there are no targets. And then.
But you would have put us, Mr. Masting, in various appearances before the committee here. You would have certainly, I would have interpreted that one of the reasons, apart from your financial reasons as a bank, one of the reasons you were bringing them down at such a rapid rate was because you were being put under pressure by the ECB as the regulator for permanent TSB to get your non-performing loans down in an expeditious fashion.
I absolutely have a regulatory requirement to have ambitious but credible plans to reduce NPLs, given that we're one of those outliers that I mentioned. From my own discussion with the ECB and the CBI, as well as reviewing what the...
Were you regulated directly by the ECB?
We are correct. As well as reviewing what the regulator said, the real point is that reducing to a European average, whatever that is at any point in time, is the very least that's expected of someone like PTSB, because
the average at the moment is what, about 8%?
It's about 3.5% is the last time. So if I then come back to, and I'll defend, I'm in a public forum, I will defend the regulator. At no time have they given any specific instructions as to how we should reduce the NPL ratio. And I would equally have absolute
So they would not have insisted on selling to funds.
That's correct, but they do want.
So that was a decision for the board of Permanent TSB.
Yeah, and as per my opening remarks, I hope I have explained the journey from 2012 to a place where we get to a place where the least worst alternative at this point in time to meet the ECB's requirement, which is to have an ambitious and credible plan to reduce NPLs materially, is the loan sale.
And what percentage, you're at what at the moment?
Post-Project Glas, I would expect us to be at circa 16% NPL ratio.
And what's your target in terms of over the next number of years?
From my own perspective, to try and get the bank safer, I'd like us to get into single digits if we can.
By when?
As quickly as we possibly can.
That's a bit like the ECB saying that we want you to bring it down, but we're not telling you how to do it. You need to give us some indication, because we've people that are fearful that there'll be further sale to funds.
As per the question that I answered, we are considering options today to get it down from 16 to single digits, and I'd breach disclosure requirements if I went any further than
and
that.
You anticipate that you'll be down to, we'll say, 8-9% by when?
I'd like to try and achieve that in the next 3 to 6 months.
And what level of billion of loans would that, to bring it down, what level of loans are you talking about dealing with non-performing loans? How many billion?
A couple of billion.
1.5 billion,
yeah,
around that level.
And the Glas one you've just selling, what's the total figure there?
That's 2.1.
And you're looking to that in the next 3 to 6 months, is that correct?
In a relatively short time period.
So how do you do that? If you're looking 2.1 you have to sell to a fund, how can you get down by another 1.5 billion in 6 months without selling to a fund?
As I said to your colleagues, we're looking at all the options, including potential capital market solutions. I'm afraid I can't answer the question this morning.
Is capital market solutions, what's that in layman's terms? What do you mean by capital market solutions? You're talking about?
Could be a loan sale, could be securitisation, could be another structure that a countermark might come to us by.
Will it involve the sale of loans?
I can't.
With all those propositions,
I wouldn't rule anything in, and I wouldn't rule anything out this afternoon.
But how many, are there any of those measures you've mentioned there that would be internal restructure of loans? I mean, everything you've mentioned to me there would involve an external sale of loans of some form. Your securitisation is a sale.
I think it's, I can take up, like we're working through the book, and that if you look at our results, which we announced on the 29th of August, we have 200 million of our portfolio that's returning to performing in the next 12 months. We have another 160 million of customers that we believe fit into mortgage to rent solutions, so we're working on that quite extensively. It's a slow process, but we're working and have identified that cohort. And then there's other cohorts that we continue to work out. Some customers are in bankruptcy arrangements, and therefore they have a natural life cycle. So lots of different cohorts.
Of the 1.5 billion you're looking at, what level of that 1.5 billion do you believe you cannot deal with internally?
These are primarily customers that we have dealt with already. They are on long-term treatments, but they have an NPL status, and will continue to have until the end of until they finally pay off their debt.
And how many of those could you not come up with what we were told by the ECB? Could they not be restructured in a way where they become performing loans in terms of restructuring? And Mr. O'Sullivan would take up that point, because what we got from the ECB it wasn't even a degree of materiality. They were only interested in, if you took a loan, what level of that loan could you get to a point where it's performing? It could be 10, 15, 20 years, and the rest of it should be put in, that would be senior, and the rest of it put into junior and warehoused, and a full provision made for. So the question I suppose I'm asking is, I don't like these sales to funds. I don't think the funds are structured to deal with them. I would prefer it to be done in-house. We got the impression from the ECB that they would like to see more and more being done in-house and restructured. In fact, I felt they were frustrated with the banks that they weren't doing enough in this area. And I would feel that from a lot of customers, we get it, is that there has been constructive non-engagement by banks on the basis that they have the moral hazard of being able to sell on to the funds. So you might just deal with the technical point, Mr. O'Sullivan, in terms of what the ECB informed to us, and can that feed back into the 1.5 billion, Mr. Crowley, that you need to address in terms of the NPLs?
The description that you put to us is the comment that I mentioned in my opening remarks, known as provide and de-recognise.
Providing
and de-recognise.
Okay.
And
that's the senior and junior.
That's what that meant in here.
Okay.
Okay. At this stage, we're considering all the alternatives, but I absolutely want to place on the record that my motivation was, and always will be to get the right deal for all Irish taxpayers. And so I need to compare and contrast the different alternatives.
But Mr. Masding, is it a point that there's a level at which you won't go for a restructure? So let's say €200,000 mortgage, that you won't go for a restructure below 100,000 or half of it being deemed to be functioning, because on the basis that the level of provision, the 100% you'd have to provide for the junior, that your balance sheet cannot sustain that.
I think that is the consideration. And yes. I think how you described it in terms of senior and junior is extremely well put. The only flaw is in your example of 200,000, where you said 150 for senior and 50 for junior. The actual figures are 100 and 100.
So go to the 100, because we went down to that level. Mm-hmm. And the ECB said to us, if the 100,000 you got to the level where it's functioning, they weren't interested in the length of period, so long as if someone will say in their 30s, it could be put over 25, 30 years, so long as the loan that was in the senior was deemed to be functioning, they just wanted to make the provision on the junior. So are you saying to me that you cannot, as a bank, that your balance sheet cannot afford that level of restructure?
I think we're talking across purposes. The answer to your question of in isolation, is that a legitimate alternative that one could think of? The answer is yes, it is. However, what we need to think about is within the capital envelope that we have and within our duty to all Irish taxpayers, we need to compare that alternative to others which I haven't got on the table yet. And I can assure the committee that the board, myself, would make a recommendation to the Minister which would be around the best decision for all Irish taxpayers, and that's probably all I could say today.
But can you make the point as well that if you warehouse a proportion of the loan,
which we do anyway, because these are all split
I accept that, and you keep it in-house, you may have some possibility of getting that warehouse portion back in the future years, whereas if you sell it onto the fund, you have none. I'm just making the point.
Your point in isolation is correct, but unfortunately, as you and I both know, because we've sat opposite each other on many occasions, isolation doesn't work. The unfortunate thing is, because the warehouse is deemed unlikely to pay, the loan is a non-performing loan by definition.
So could you make the case then that your balance sheet cannot sustain that level of the ones I'm talking about, the really difficult cases? So instead,
I don't think that's true. I think the point I'm making is that my duty is to ensure that the capital that we do have is used for the best of all Irish taxpayers. That's the simple answer.
But do you feel you have a duty? Finally, do you feel that you have a duty to the mortgage holder that you in some cases they would have bought at peak levels that they can't afford. Surely in terms of the customer charter, you have a duty to the customer as well.
I think we've met that duty through the long-term treatments, and I think we've met that duty by absolutely avoiding scale repossessions.
So can I then finish? So you're saying that you have 2.1 million in Project Glas, and you would expect that by the middle of next year, you'll have dealt with another 1.5 billion, which in total will be 3.6 billion in total in terms of non-performing loans, and at that point you would be down to 8-9% non-performing loan ratio. That's your target?
I want to be within the European average. You said something I thought quite interesting in your comments around that, and I might be, this is an assertion, but I took it to mean that very early on in the conversation, permanent TSB was referenced as one of the Irish banks in your SSM conversation. And from my perspective, I don't want PTSB to be a bank that is known in the SSM at the wrong end. And my duty is to try and get the bank to be safer. Secondly, then, to do that, we do have an aspiration to reduce the NPL level further materially in the near term, whatever that means. And that would be my answer.
And then the final point is, what determines whether a loan went into Project Glas, the 2.1 billion and the 1.5? What's the determining features that determined that loans went in under Project Glas and the 1.5 left over billion?
Save me, I don't know whether you have my,
sorry.
I don't know whether you have my comments in front of you. Save me reading them out. If you look at pages 7 and 8 of my comments.
It could be page 4 for you as well.
Okay.
It starts, it's halfway down, it defines what's in Glas.
Okay. And what's left in the 1.5? What's in there?
Primarily the 1.5 are long-term restructures that are PDHs. So all buy-to-lets are in the Glas portfolio.
And how many of those do you anticipate to return to performing within the next 6 months?
In the
1.5?
They will not, because they're long-term restructures. They won't return to performing for many years.
Okay. Thank you.
Can I ask you a couple of questions on your opening statement?
Yeah.
You see some stuff
of course,
there
yeah.
in animation. On your opening statement,
Yes, sir.
you open up by saying that you're following the rules and directions of our regulator. Now, this was covered to a degree by Senator O'Donnell, but it's the wording of what you have to say. And you said that that direction from the regulators is very clear. You must reduce the ratio of non-performing loans on our balance sheets to the European average, which at one time was 5%, and now it's 3.5%. They've never told you that.
I beg your pardon?
Where did the central bank or the European Central Bank tell you that?
We have communications, as other banks do, that we are required to have ambitious and credible plans to reduce NPLs.
But they've never said to you that you have to reduce them within a certain time frame to 3.5%.
If you have a ratio of...
No, don't if me. If
you have a ratio of 25, I would have thought that it was perfectly rational to think that ambitious was credible.
That's not the question. The question is, when did the regulators tell you this? When did they say you must have it down to 3.5%?
The request, Deputy, was that the banks would prepare credible and aggressive plans which would reduce their NPLs over the medium term. The medium term is deemed to be 3 years.
The ECB and the ICB and the SSM gave you no such instruction, and they've confirmed that to a delegation that attended. And it is wrong for you to give the impression in your statement here that you're acting under the cosh of these three different organisations. They never said it to you, and they've confirmed that to us. To move along to the 13,800 homes.
Sorry, where in my opening statement do I specify that? The words I use are...
Look, Mr. Masding.
On the subject of NPLs...
Sorry, Mr. Masding. I want to just clarify that for you. You asked me a question. It's in the first paragraph of your opening statement. And at no stage did any of the three that I have mentioned ever tell you directly what to do in your bank relative to the 3.5% or how you could achieve it. That's the first thing. The next point is, you say that you're complimenting the 13,800 homes that have been restored to performing loans. And, you know, again, that's to give the impression that those that are left then in your bank are the ones that responded the least to any kind of treatment or cure. So you then say that the selling to the vulture funds is a legitimate tool for banks to use to reduce NPLs. And you're saying that, again, that the European Commission, the SSM and the Central Bank of Ireland have all said that loan sales are a legitimate tool, is a legitimate tool to sell. But it may very well be a legitimate tool. But they never told you to sell directly to vulture funds. They just recognise that it's a legitimate tool, that's all. There are many other options. So I find that misleading. In terms of debt forgiveness and write-offs, you give us your definition of moral hazard and all the rest of it. I find that hard to take, coming from a bank that actually led these people into the debt that they're now in. And then you go down to provide and de-recognise. You say that you did not pursue this particular method. But there's nothing wrong with that method. You could very easily have taken that as an option. So it's residential mortgage-backed securitisation would allow you to de-recognise the loans from its balance sheet, from your balance sheet, reducing the NPL ratio, and avoid portfolio sale. That's what would have happened. It's an accounting procedure, and the loan holder is still on the hook, and yet you won't consider it. Now, you talk then about, which I find completely offensive in the way you've presented this. They've been poorly served, customers have been poorly served by inflammatory and inaccurate commentary around your transaction. Can you drop us a line and let us know specifically what you mean by that? Who are these people that have put out these inflammatory and inaccurate statements? Sure, we'll have to hold them to account, won't we? They can't be saying bad things about your bank. So if you believe this, then perhaps you might write into us and tell us where these statements were made. I doubt if you're referring to the committee members, are you?
No.
No, that's okay. And then you go on, another inaccuracy. You say, well, it's accurate and it's inaccurate. That the protections follow the loan and that these vulture funds have to, acknowledge the protocols that are in place. You know damn well that's not the case. You know that the reality of this, that once you're transferred to a vulture fund, you're in trouble. That's not inflammatory. It's not inaccurate. It's simply a statement of fact. Now, to support that statement of fact, if you look at any of the lists that are before the courts at the moment, you'll see most of the vulture funds listed. Start Mortgages is one of them. All listed taking cases against individual homeowners. That's from a circuit court down the country. This is from the Masters Court. And what I'd like to find out from you is, can you provide us with just the overall figure for the number of court cases that you have going through the courts at present at different levels relative to home loans, homes connected to buy-to-lets and so on that you are pursuing. Can you do that?
Shane, have you got the court
Yes,
case?
so in terms of the court, we have around 2,500 cases.
Yeah. So you have 2,500 cases currently before the courts, challenging those that are, some of them, engaging with you because they've come to members of the committee. So you've sold on all of these loans, and now you're pursuing, at the same time, 2,500 cases through the courts.
Well, no, they're
So
the same numbers. So the 2,500, by and large, would be the cases that are in Glas.
So even though you've chased 2,500 through the courts, waiting for justice is not going to happen for that 2,500. Not with PTSB anyway, because you've sold them on to the vulture funds. And do you think the vulture funds are going to, take back these 2,500 out of the courts and restructure them? You seem to think that they're a very generous lot, that they do deals. Do you think that would happen? Is there scope for the 2,500 to come back to you and say, please don't sell us to the vulture funds, we'll work with you?
Well, I heard the deputy earlier.
No, I'm just asking the question.
Yeah.
Don't mind what everybody else said.
Well,
I'm asking you a question.
A couple of
I
things.
think I answered it, didn't I? We can't put ourselves in the shoes of Star Mortgages.
No, but you were in the shoes, you see. You've tossed your shoes away. So when you were standing in the shoes of PTSB, challenging 2,500 homeowners, loan owners around the country, that was the time to address it. What you're doing is you're outsourcing your dirty work to a vulture fund. You're ignoring the possibility of provide and do you recognise, or working individually with the people that we're talking about. That's essentially what your answer to me now means, Mr. Masding. And that's cold comfort for those 2,500 people who were before the courts legitimately, who were seeking justice for the predicament that they found themselves in. And you have pulled that legal process from under them, and you've sold them on to a vulture fund. So tell me, Mr. O'Sullivan, in that 2,500, how many of those could have been helped by the likes of David Hall and iCare or whatever the project is today? Did you run it by people like Mr. Hall?
Yeah, we did. So
you run the whole 2,500. You ran them by.
So what we did was, we mentioned earlier about the large number of exclusions. So one large batch of exclusions were potential mortgage to rent accounts. Customers that we feel, based on everything we can see in front of us, could avail of mortgage to rent.
As part of this 2,500?
Yes. Yeah.
And
so some will be in that and some won't. But the key point is that we excluded up to 700 loans from Glas because we believe that...
Were they part of the 2,500?
Some of them
that
will
are
be
before the courts?
Yes, some will and some won't.
I am anxious to clarify that because I don't trust your figures. 1,050 you say were, and another number, you said at one stage that these were homeowners. The 1,050. Were they ever, presented to the likes of, and I'm only using David Hall as the only example I can think of right now, who has one of these initiatives in place that might be able to help them. Were they helped?
So, if you give me a moment, I'll explain all of that. So, we took up to 700 accounts that we feel could qualify for mortgage to rent out of the sale. Okay. Not only have we worked with David Hall's iCare, we've also worked with another partner, Home for Life, and in addition, a third party, which is the existing scheme, the AHBs. So at the moment, we have over 300 of those 700 accounts that are being progressed through the mortgage to rent scheme, either through the AHBs or through care
Okay.
or through Home for Life. If I may, that's the first point. The second point I have to come back to is on the courts, and it came up earlier with the Deputy as well. Like, if you look back at what we're all attempting to work through over the last 10 years, a very important stat, about 1 in every 5 mortgages has been in arrears, okay? But less than 1 in 300 homes have been repossessed through the courts. So it is a cliche that it is the last resort. So we don't rush anywhere quickly to the courts. And even, I would say, I've sat in many courts and I've seen many of the cases play out. An important point to make is that the court system will give the borrower every single chance that they possibly can until they can give no more chances. And that,
Well, then why
that's
didn't you allow the
reality.
2,500 go through the court system?
Why didn't we?
Allow the 2,500 that are currently before the courts to exhaust that before you sold them to a vulture fund.
And that's what we have been doing for up to 10 years.
No,
with some
no.
of
You have
those accounts.
2,500 before the courts.
Yeah. And
And you've pulled the legal mat from under them and you've sold them to a vulture fund.
so most
So you
cases,
didn't give them a chance.
No, most cases these days will take up to 7 years in court.
But
So-
that's justice.
Yeah, and that's fine. And we're
But
fine
you've
with
taken that away from the 2,500.
So at some point, we have to recognise that the bank has a very significant NPL ratio that it's attempting to address. And that's for the good of the bank and ultimately the state, which is a large shareholder. And, you know, there is an alternative possibility here that from a customer point of view, that the circumstances are unchanged. The T's and C's don't change. The regulatory environment doesn't change. The legal system doesn't change. So there is an alternative reality that reducing our NPL ratio strengthens the bank's position, which is good for the state and its taxpayer, and that actually the scenario for customers is unchanged.
To go back to I don't believe any of that. It's a lot of nonsense that you're peddling for a good while and being supported by some commentators, but it is in fact totally untrue in reality and in practice. The 1,050, you're saying had at one stage the statement read that you had 1,050 buy-to-let loans. The 1,050 loans that we're talking about earlier on, that these were attached to a buy-to-let property. In a statement from PTSB, that was said. But you now disagree with that. You're changing that, are you?
I'm not close to that statement, but I don't believe it did say that. My understanding is that it broke out the 1,050 and explained that some of them originally were buy-to-lets, others though were simply not sustainable, and others was a catch-all for long-term arrears is my recollection. So I don't believe that any statement says that those 1,050 were homeless. So, yeah.
PTSB confirmed that 1,050 loans on family homes which are performing or meeting the terms of an agreed restructuring arrangement are included in those being sold. So, in the case of these homes, again, you mentioned 3 different possibilities for them. Did you apply any of those 3 possibilities for them in relation to a solution before you sold them?
Again, I'll come back to Jeremy's point, and Eamon has confirmed that every loan in the transaction is an NPL. It has a status of non-performing, and that has been checked, and we'll continue to listen to anyone that wants to tell us that there's an error there. But all of the loans, as part of the Glas portfolio, are non-performing.
Okay, let me give it to you in a different way then. in a report through the media, it says, shortly after Project Glas loan sale, it emerged 1,050 mortgages on family homes were included in the sale and were performing, or they were meeting the terms of their restructured arrangement. Is that true?
I can't say for sure.
Why?
I didn't produce the statement, so I'd need to see the statement. I appreciate
It's not
it
a
comes from our
statement,
bank.
it's a report that has said, so don't mind where it came from, right? 1,050 mortgages on family homes were included in the sale were performing loans, or ones that were meeting the terms of an agreed restructuring. Is that true or false?
I can't say without seeing the statement and the detail, but
No, I'm just giving you. This is what is being said of Project Glas.
By who?
Don't mind by who. Is it true or false? Is the statement true or false?
There are no performing loans in Project
Glas.
Glas.
There's no performance, so this is wrong. There's no performing loans.
The statement is inaccurate.
There are no,
Yeah,
all the
that's
loans
okay.
in Project
Let's
Glas
get
are
it
not.
out
Yeah, the
there.
statement is inaccurate. The breakdown of the 1,000 relate to homes that are not sustainable, so no treatment was possible. Homes where there was long-term arrears or other, and these are unfortunately customers who are classified as unlikely to pay in the future or satisfy the debt. Or there are loans that were originally classified as buy-to-let, but in fact had switched into primary dwelling houses, but in effect they're all non-performing, classified as non-performing,
You classified them as non-performing.
under EBA guidelines.
And in terms of those that were restructured and were following their restructured arrangement, were they sold?
In cases where they were in arrears, they were paying
So
something to clear their arrears, but their arrears were continuing to build. So these in effect are classified as NPLs because they have a situation where they're in long-term arrears or unlikely to pay, and that's a classification set down by the regulator, not by us.
So there was nothing that you could do to save that 1,050 from going from the bank to a voucher fund? Did you exhaust every avenue with them? Did you get the 3 different projects, let's say, that helped you?
We did. It's back
You
to the
did.
point that we took 2.6 billion or 48%.
Just stick with this for a minute.
Well, then
I feel that we exhausted all the options.
We did.
You exhausted all of the options. Okay, we'll see about that. If I can just move then to I've dealt with the regulator. You say that START offers solutions that high street banks don't offer. You said that earlier on. What are those solutions?
So it's understood that the funds will offer some form of debt forgiveness or right sizing.
Where do you get that from?
Well, that's common
That's
knowledge.
how they work. That's market convention.
Sorry?
That's market convention.
So what you're saying then is that START mortgages on the portfolio that you sold, that there may be options there that are better than your bank because you believe that there is proof there that they offer solutions which include write-offs.
That's correct.
That's correct, is it? Okay.
Forgiveness, not right.
Huh?
Forgiveness.
Whatever way you want to phrase it. You constantly refer to the taxpayer and the best deal for the Irish taxpayer. So, you sell off the loans, thousands of them. Some will possibly end up losing their homes. There may be a tsunami of repossessions, in spite of what you say. And then these very same people will end up on housing lists, looking for homes to be provided by the state. So you're back to your moral hazard again, and you're back to the fact that repossessions will happen and it will cost the state. So I don't take your statement very serious in relation to Irish taxpayers. You have no interest in the Irish taxpayers. Your only interest is in your bank. And that's borne out by your actions. So let's go back to Senator Conway-Walsh's question, and I want to understand these figures. The 1,800 houses that you have in stock, is that correct?
Correct.
Okay. So that's the total figure. And out of that 1,800, you have sale agreed on 330.
Correct.
Is that?
Yes.
Then you used a figure of 500. What was that to do with? Sorry.
405.
405
For sale.
are for sale.
Yeah. And then there was an additional 408 that are being actively prepared for sale.
Being prepared. Now, the question was asked, out of this 1,800, given the ones that you've sold, the ones that are the ones that are sale agreed, did the government buy any of those houses?
Not as yet.
Not as yet. They bought none of them in the stock that you're talking about here?
No.
Okay.
But they are within the for sale figure because they are actively looking at properties.
Yeah, but they
as I
haven't
mentioned.
looked at the 330 where you sale agreed.
No.
And neither have they
They're in the
bought
for
properties.
No, they're in the for sale. So,
How do you maintain that?
well, the properties are for sale, and the government agency is looking at them and has given us every indication they're very interested in a number of the
Okay.
properties. So, if they don't sell through the agency, well, then we'll sell them in a more conventional way, as we do with all our other properties. So the properties right now are for sale.
Did you want to come back in on that particular issue?
Maybe could you tell us a geographic breakdown of the properties that are for sale? How long would it normally take you to sell a property that wasn't being sold, say, to government, or to sell a group of properties?
So
I just
normally,
find it astounding that it's, we're 8 months later and...
so typically a sale would take 9 to 12 months from the time that you put it on the market to the time that you execute. The properties themselves are widely spread. There's no particular concentration.
So you couldn't give a percentage?
Where they're
for that?
located?
Not
now.
Not now. Yes.
Yeah,
Yeah.
later.
Yeah.
And I asked a question there about the court cases.
Yeah.
Can you give me a breakdown of where those court cases are? Maybe 20 in
Yes.
Kilkenny or 10.
Yeah. No, absolutely.
You can give us
Yeah,
those as well?
We can. Yeah.
Okay, close. Senator, go ahead.
Just a short yes or no question. Can a non-performing loan be turned into a performing loan? Because
Yes.
what you're implying is that it couldn't, so it certainly can.
It can, and it depends again. It's back to, are they deep restructures or not? But some loans can come out of non-performing status and some can't.
Okay, and you have the criteria for that to happen? What needs to happen?
So again, it depends on the loan. So for the light restructures, once the account is back up to date, there's typically a 12-month probation period. And once the loan continues to repay, as it should over that 12-month period, the loan is no longer deemed to be a non-performing loan.
So
Maybe just have a go at summarising it. At its most simplest, it goes back to performing if it goes back to the original terms of the contract that was signed on the first day.
Not the restructure.
Not the restructure.
Yeah, but obviously I have it explicit here.
The first
from
day,
the European Central Bank to our MEP Matt Carthy in terms of how that can be done and how non-performing can be turned into performing. So if somebody comes into you today with the arrears that are owed, first, do you accept those arrears? And then if they continue to pay the interest and the original over a 12-month period, then they automatically come out of non-performing.
Broadly, yes. So it goes back, as Jeremy says, to the original contract. So it depends what is paid. Is the amount that wasn't paid, paid? Is the interest that was due but not paid, paid? And then does the account perform as it should for 12 months? Okay? So if that happens, then the account can go back to performing. For some of the deeper restructures, the structure was that the interest isn't repaid. So Like we had an example earlier where 100,000 continues to be paid, the other 100,000 isn't paid, and the interest is not asked for. That account will never go back to non-performing status until all of the capital that isn't paid and all of the interest that wasn't paid is paid. And it's unlikely that customers with split mortgages would pay interest that they didn't have to.
But if somebody comes in, right, and they pay the arrears,
Yeah.
or the interest, anything that's owing up to today, and then 12 months from now it should automatically become, if they continue paying over the 12 months, it should be a performing loan, yeah?
Broadly, the probation period is slightly different for different types of structures, and then we also have to be careful that it isn't connected or cross-collateralised with a different loan that is an NPL. So once you can satisfy all of that, yes, it's absolutely possible.
Yeah, it's just the broadly part of it, I think, that is concerned, because that it creates an ambiguity. So, but if somebody, say somebody owes 5,000 on their arrears on their mortgage and they go into you today, do you accept it? Do you ever refuse it?
No.
Would the bank, PTSB would never refuse somebody saying, I'm going to pay you today the 5,000 that's owed on my arrears?
Once we're satisfied with the source of the funds, the legitimate funds, we will accept those funds.
What do you mean once you're satisfied at where the funds have come from? Surely it doesn't matter as long as it's not legally, and it wouldn't be your job to see where the funds have come from.
No, but again, we'll have AML, anti-money laundering obligations. It's a small point, but we will accept arrears payments all of the time, meeting our wider banking obligations to ensure that we understand the source of funds. But yes,
So yes, you would never refuse customer coming in with an amount of money to pay the arrears unless you were suspicious that it had come from an illegal source. Is that correct?
Correct.
Okay, because that's not. It's my understanding that monies being paid in arrears have been refused by PTSB. So that's interesting to have that on public record. Thank you.
So again, we're happy to speak to deputy senators on individual cases outside of the public session.
I'll give you a bit of a response from the public when we do that. So here's a case, just to touch on it. I'm not going into detail. I just want you to understand the effect that this has. So there were PTSB for the last 10 years. I got a letter from them beginning of August, say their mortgages transferred. They fell into arrears 2016 for 6 months, €3,000, and their mortgage has been transferred. And then they outline in detail the fact that they're living in fear, and we feel we have been very badly treated by the bank. That's from one of your customers. In relation to another, I brought it to your attention, and the writer says to me, yes, PTSB issued a response, which I received a little over a week ago. No, I'm not happy with the response, because I don't believe they actually looked at anything in any different way. They just got holding letters. So if you think that's a response in some sort of special way to a member of the committee, I don't agree with you. The other was a case that I gave you, which, out of courtesy, this person wrote back just to give me the update, and said that they had no outcome whatsoever from PTSB, or even a response from Mr. Masden regarding our €60,000 overpayment. It's now a year since this query has begun, and 8 months since Mr. Masden said he'd look into it, and nothing constructive has happened. This is another letter from an individual whose loans have been sent on to a vulture fund and sold again by that vulture fund to somebody else. And what struck me about it was that it started at a very low amount. There was a resolution to it. The man went into bad health and tried to deal with it as best he could. But again, the response from the bank was such that he believes he got no hearing whatsoever. So they're just a few letters that I want to refer to and say to you that, you know, you're not building confidence with your customers by virtue of the number of letters that I received, and indeed by your interaction with this committee. That's, and I will pass some of these on to you again in the hope that you will look at them in a different way. Because, for the record, I just find it shocking, your approach to all of this, what you're prepared to do for the bottom line in your bank. Deputy Burton, do you want to ask a question before we
It's a very,
wrap up?
very brief question. It's just following on, as it were, from some of the points you raised. We've been advised that the average loan value in relation to our discussions today is 175,000, the average loan value. And secondly, that the average arrears time of the loans is 3.5 years. And thirdly, that the average arrears value is 28,800. Now, I think in terms of what you're telling us is a management process, which a lot of us are struggling to understand from your perspective. Would you be kind enough to get us what are the highest value loans in the top category? Like, are there people who are in arrears to the tune of, say, more than 50,000 or 100,000? And what are the lowest values? Because we have actually had letters to the committee, which I think the Chairman has passed to you, which have shown that particular loans have no arrears at all. Now, I do know in the earlier conversation with the Chairman and others, you did say that the same person may well have another loan. But, you know, to be perfectly honest, if somebody has no loan arrears on their family home, but they have a business situation where, or a buy-to-let, as you referenced earlier, Mr. Crowley, I actually think, you know, it's actually really quite unfair to, as it were, undermine the security of the family home which has been paid. You know, I have to say, it's not an unreasonable tactic for a family where they have a number of loans to say we will prioritise the family home so as to ensure that the family home is secure and that they pay all of that. But they then have one or perhaps another loan which you made to them in relation to something like tracker mortgages or whatever, maybe development land, I don't know. I mean, just again in terms of, you know, the moral hazard at the moment rests with families losing homes, and with when the families lose the homes, there actually being no easy alternative in most of Ireland to replacing that home, and no easy alternative in most of Ireland to finding a rental property at a reasonable cost to allow that family to rent. So I think if you could go behind those figures that have been made available on the averages, like it seems the average arrears value of 28,800 to me seems very low.
You might provide maybe a spreadsheet of general information, if you can, on that.
We can't provide any further information as per my previous comments. We've entered into a commercial agreement now, so the information that's in the public domain is the only information that we'd be able to provide.
And is that by the order of the central bank or what?
No, that's the commercial agreement. It's a market norm that when you do a transaction like this, there's a non-disclosure agreement at the point of signing, and we have to abide by the.
You might let us have, Mr. Masding, where the basis of that. What we're asking for is a very generalised set of figures. Now,
let me go back and I will.
If you wouldn't mind going back.
Yeah, let me see what I can and can't provide, but the general perspective.
Because you gave a no answer to most of the questions here today, rather than a yes, or rather than even being informative. So I'd ask you to facilitate, Deputy Burton, by allowing the committee the extent of the information that you can give us relative to the question that she asked. I'll just finish it up here.
Just finally, like the ECB doesn't say that they have to be back to paying the original terms of the mortgage. And could I just maybe propose that the committee here would contact the ECB again after today's hearing and seek clarification on some of the points that we haven't got clarity on today.
And we welcome the information we've asked you for, Mr. Rousing, in a timely fashion, if you wouldn't mind. And just to say quite clearly to those borrowers out there that are caught up in this, that it is my belief that the opening statement has been constructed in such a way to deliberately almost mislead people into believing that there is regulation in this area, that it's all okay, and that you did your best for the taxpayer in relation to this. And I completely reject that those parts of your opening statement. I just think they were absolutely misleading. The Joint Committee is now adjourned until 9:30 on Thursday, 18th of October.